Good afternoon, all. Good afternoon, sir.
Good afternoon. Good afternoon.
Hello.
आपने लिख दिया ना? I can't see somehow.
So वो Q&A में where they were asking the questions, उसमें answer का एक option.
I'm just seeing के तेरा है कहाँ?
And once a day, we can't. I can't. That's not something I'll renew every year. और जो सारे एनुअल लीव का ही फिर सिमिलर हो गया.
Good afternoon, everyone, and welcome to PhD webinar on TDS. This webinar is with a view to facilitate a better understanding, to promote compliances, and to facilitate an informed dialogue between assessees and the tax department on TDS provisions. The concept of TDS envisages the principles of pay as you earn. 50% of our tax revenue is collected from TDS. It facilitates sharing of responsibilities of tax collection between the deductor and the tax administration. It ensures regular inflow of cash resources to the government. It is a powerful instrument to prevent tax evasion and for expanding the tax net. Expansion of the tax net is a high priority for all stakeholders. There are still too few taxpayers in our nation, though the numbers are increasing through fine efforts of the government. The topics of the day on TDS cover a broad spectrum of matters. Aspects are being discussed by a formidable team of speakers, and the discussions will include provisions, compliances, issues, solutions, and also improvements being sought. The focus includes interpretation issues and improving the understanding of the subject on procedures and initiatives of the department. In our nation today, ease of business is stressed. Facilitating and assuring a simplified, taxpayer-friendly regime and smoother compliances and processes are accordingly welcome. We appreciate that our finance minister has said that it has been the constant endeavor of the income tax department to improve taxpayer services by making compliance easy and smooth. The topics cover also aspects of assessees in default, along with related interest penalty, and in extreme cases, the possibility of prosecution. Assessees seek relief from any unwarranted loss and hardships where people are acting bona fide or where errors may be made due to inadvertent technical or venial breaches, or where the errors are because of debatable interpretations of law, where two reasonable views are possible. These are settled principles that such aspects should not be penalized. They would constitute reasonable cause. And we would urge that these are well kept in view by the administrators. Over time, some important department circulars have been issued to remove difficulties and to enable clarity in compliance. Further comprehensive circulars updated on various aspects or issues in this matter may be considered and would help compliance and certainty. The consequences of non-deduction of tax at source and the related provisions are severe. The assessee is not only considered an assessee in default, liable for the sums, but also charged for interest, penalty, and there may be related non-deduction of the expense under Section 40A. The spread of TDS is increasing yearly. As I said, it is now around 50%, up from 40% of the overall tax revenue in the last few years. It would be good to educate taxpayers on the provisions, on issues, and on what would be the safe view where problems are involved. We further suggest setting up a TDS ombudsman for grievances and efficient forums where one could take one's query and avoid litigation. Clearly, avoiding litigation is better than settling litigation. Provisions of Section 197 should permit all aspects where one could go to the assessing officer and where required by an appropriate senior forum to seek clarifications. Various initiatives have been taken by the systems and the tax department. These measures have introduced objectivity, reduced human interface between the taxpayer and the officials, and are leading to efficiency and fairness in an increasing manner. Clearly, the department too is interested that there is less hardship and increased efficiency for tax compliers, but there is still much to be done. All best practices that promote compliance are welcome, and all fair, just, reasonable treatment on the side of the tax collectors is similarly welcome. We deeply appreciate that the government has stated that the tax department is expected to function not only as an enforcement agency, but also as a facilitator. It is said, and we quote, "We are committed to provide a stable and predictable tax regime that would be investor-friendly and spur growth." We hope that there would be measures which would go a long way in making India a preferred destination as we see the rise of Incredible India and Make in India, and where India finds its true calling amongst the leaders of the world. There are some points that need consideration where we would seek improvements and clarifications or removal from hardship. Some of these points are that sometimes it takes a fair bit of time between the processing people and the assessing officer to rectify errors or even uncalled for consequences are there, whereas rectifications are pending or erroneous treatment has been done. This needs to be eliminated or much reduced. There are mistakes made by deductors. Again, this is part of education and enforcement. A payee, a deductee is dependent on the deductor. Deductors must ensure that they comply. They must be conscious of their role, and they must remember that their error is costly for the payee. Supposing a deductor does not fill his forms properly or details properly or does not deposit what he deducted, it is clearly leading to difficulties for the deductee for no fault of his. And he has no choice but to rely on the system and the tax department to help him get his rights. Efficient timelines would be welcome. This includes for refunds. And this would be increasingly possible if there is a list which is capable of being discussed and automatically put up for delayed actions for higher authorities to see and take action on. there is sometimes differences which are caused by certain typical points that are repetitive. But methods have to be found, reconciliations have to be found, efficient treatment has to be swiftly found, so that time and again those differences do not survive and do not create needless complication both for the department and the assessee. For instance, if there is an assessee who has a cash method of accounting and the payer has mercantile method of accounting, then there will be difference in the treatment between claim of expense and showing of income between both of them, between deduction of tax at source and its eligibility as a claim in the hands of deductee who can only claim it when it is his income. There would be difference in 26AS, but the reconciliations should permit this to be sorted out as part of the system and swiftly. MIS may entail, as part of efficiency and control, monthly credits of provisions. These are then written back. There should be no issue, and it should be clarified in the field that such MIS credit are not credit to payee, nor do they constitute deemed credits to payees as so-called credits to suspense account, because that is not what it is. It is just an MIS. It is not even year-end. It is reversed during the year itself. How to educate? And all of us are involved. We are all stakeholders. Large institutions such as banks to comply and understand the pain that is felt if there are gaps in compliance. So if there are gaps in TDS computation or compliance by the institution, then it is going to rub off on the assessee or deductee. Certain differences are there in some cases between treatment of non-resident and resident. Rather, if a non-resident is not ordinarily taxable, then it should be smoother for him not to have TDS or not to have such differences. Now, Section 40A says if there is a TDS default, then there would be a disallowance of 30% if the amount was not actually paid. But in case of non-resident, it is 100%. As we move forward in global business, as we welcome international business and investment, these differences need not survive any longer. There are well-known decisions of Supreme Court, High Courts, governing High Courts on what constitutes reasonable cause, such as when there is a reasonably debatable point of law. And these decisions should be well disseminated in the field, so that at first count itself, there is no penalty that is levied, so that all concerned are saved from litigation and resources can be used more productivity. More productive use of resources would only lead to more tax in the long run. So let these decisions and fundamentals be known as to what constitutes reasonable cause. What has the Supreme Court said? What has the governing said? At least that should be followed. Comment again on non-residents. We have heard that there are large refunds because TDS rates are high. And we had even heard, it was announced by a senior officer, that TDS rates were expected to be reduced for non-residents. But we saw in the recent budget that these have been increased. Now, as it is, there are large refunds. It is a process. There are aspects of resource and efficiencies involved, costs involved for all concerned. And also the aspect, as always, and importantly, of India as a preferred destination. So we need to have rates that are not only dependent on tax treaties, but are in themselves such that would be more conducive to there being less of refund going back. First we collect, then we give back. it may not serve any useful purpose. This needs to be measured and seen as to what is to be done. Certain special type of deductees, whether tax should be deducted. Now, let's say someone is a charitable institution, duly registered ATG certificate, but he has no exemption from TDS. And in certain provisions, he does not even have the chance to go in 197 because it is not every section where you can go in 197. He has income which is ordinarily tax-free. So once again, something needs to be seriously done here, that to what extent are charitable institutions to have tax deducted at source from income which is, generally speaking, tax exempt in their hands. Are deductees payees liable? This is interesting for participants. If the deductor has deducted and not paid, so the deductor has not complied with his responsibilities, then there are decisions which support the deductee that he is not liable. And there is also a very fair office memorandum of 2016, which has been cited in some decisions of the tax administration, that it is not the deductee who is liable if the deductor is at fault. Then please follow up and chase him, and the deductees can keep their rights in mind. GST. TDS is ordinarily on income. It is tax deducted at source on income, we should add. That is the way it is, the scheme goes. And if there is an amount of GST as a separate charge, and GST is not income, I am only collecting to deposit, then fairly it has been said, as was said for service tax, that where it is a separate charge, if you are a resident, you do not have to deduct tax at source on the GST part. It's not income. However, why resident? Here too, I would urge that similar exemption should be given for non-deduction to non-residents. Some recent concerns. Now, the definition of business connection and significant economic presence, the amendment in section 9, it is extremely difficult to monitor this for compliance purposes. You are an importer of supply of goods, you bought the goods on high seas or overseas or in a foreign territory. That man has no PE in India. Just for the sake of the very wide definition of significant economic presence, there may be a tax liability, even if only attributable. But how do I compute what is attributable? So this significant economic presence and related tax liability under 195 is of concern. This needs to be revisited, please. Do we really want it? Is it going to serve any useful purpose? TCS, LRS, overseas tour packages, some things have been said about it. But it is again important to add because some of it is still being well thought out. And I'm sure deep thinking is being done. 20% on LRS sent abroad from 1st October, over 7 lakhs. Why? I mean, it is again TDS or TCS is supposed to be on income. If I send out money in foreign exchange in LRS, I meaning an assessee, it is firstly from the bank, from tax-paid money. Secondly, it may be the assessee's India bank account to Singapore bank account. How is bank account to bank account transfer something on which tax should be collected? That too at 20%. The transaction is through bank and various forms and compliances have to be done. So it's on record. CA certificates are required. They have to be filed online. It's on record. Let's say one even makes an expense out of that money which is sent out, which one is perfectly entitled to do. Then we don't have taxation on expense. Then let's say one makes an investment. At the point of time of making an investment, there is no income. I may offload it for a loss. So why 20%? This please needs to be think. It is highly, I am not able to understand it, and it is excessive and perhaps uncalled for in the manner which I have tried to explain. Reimbursement, some of the speakers may talk about it. It is not decisively free from doubt so far. And that is the benefit of such webinars as to where would there be a TDS liability and where would there not be a TDS liability when you're talking of reimbursements. And the speakers will cover it. There are provisions where, again, when we were talking circular and clarifications, where there are possibly two sections that may apply. 194C or 194H. 194C or 194I. Now, wherever possible, these matters need to have circulars coming in, and that is the only way something can be done to eliminate non-compliance, reduce non-compliance, and eliminate difficulties, because then one knows this is what I have to do, and I go ahead and comply and do it. Thank you very much. You've heard me very patiently. We have very fine speakers to listen to, and it's a pleasure to be introducing them and interacting with them. We move forward now to the first topic of the day, which will be handled by Mr. Gaurav Jain. His topic for the day is the TDS provisions relating to 194C, which is payments to contractors, and fees for technical services and commission or brokerage, which is 194J and 194H. Gaurav has over 20 years experience in tax litigation and advisory. He's an arguing counsel in different forums like Income Tax Tribunal, PMLA, High Court and Supreme Court. He has several important decisions under his belt. He specializes in handling tax litigation and advisory of various eminent corporates and HNIs, and is also involved in representing search matters, allied laws, black money laws, etc. Brilliant young senior, if I may call him that. Ladies and gentlemen, please welcome Gaurav Jain.
Good afternoon, friends. Respected Anil Chopra ji, chairman of the session, other office bearers of PhD, and my esteemed colleagues and co-speakers on the session today. First of all, I thank Mr. Chopra for inviting me to this session and sharing my thoughts on this very complex topic of TDS. I think Mr. Chopra has very well set the tone for the day by emphasizing on the importance of TDS provisions and how these TDS provisions are gaining importance day by day. Not only the compliance burden is increasing, but also the TDS provisions have become the best bait for the revenue to maximize the tax collection. Mr. Chopra has already stated that TDS provisions by themselves constitute about 50% of the tax collection. And we have seen in the recent past that the tax administration is increasing the scope of TDS provisions year after year, not only by increasing the rates of TDS, but also increasing the scope of the TDS provisions by introducing new provisions year after year. For instance, in the recent past, we saw TDS on banking transactions, withdrawal from banks, TDS on even purchases when the payment purchases exceeds rupees 50 lakhs, TDS on digital transactions, TCS, Mr. Chopra has already emphasized, has already been increased to 20% on foreign remittances, and for which there is a lot of debate around the market. Now, friends, the topic for me today is section 194C, payment to contractors, 194J, payment for services, 194H, commission or brokerage. My endeavor today on these topics will be, when we see all these provisions, we find that there is a lot of overlap in all these provisions. A payment can, at times, can be construed as falling in section 194C, as also in 194J as service, or as commission or brokerage under 194H. So there is a lot of overlap in all these provisions. So our endeavor, my endeavor today will be to demystify that overlap, try to understand what is the distinction in all these provisions, try to understand the correct interpretation of these provisions independently so as to benefit the taxpayers and tax deductors which are forming part of our audience today. With that background, friends, I'll start the discussion for the day today. The first section which I deal is section 194C. Friends, when we see section 194C, it talks about payment to contractors. The heading of the section is payment to contractors. It does not specify as to the nature of contract which is covered in the section. When we move forward in the section, it talks about a contract for carrying out any work. So even the scope and breadth of the section, when we read it literally, is very wide. So what is the scope of the section? Whether it includes all kind of contracts, or is it only restricted kind of contracts which are covered within the scope of section 194C? Even a contract for service is a contract. So whether a service contract will be covered under 194C, then if yes, then how 194J, which deals with payments for services, is different than 194C, payment to contractors. Friends, this issue came long time back before the Supreme Court in a case called Associated Cement Company versus CIT. In that case, the assessee was dealing with a contractor for loading and unloading of bags. And therefore, and he did not deduct tax at source on payment to contractor involved in unloading of cement bags. His contention was that section 194C, by using the word contract for carrying out any work, only means work contracts. Work contracts which are given to do a specific task, either to make a product or any other kind of work contract. Only that work contracts are covered within the scope of section 194C, and any other contract other than work contract is outside the ambit of section 194C, which was turned down by the Supreme Court in the said decision to hold that the section uses the word contract for carrying out any work. So therefore, any contract which is for any nature of work, since the contract for loading and unloading of bags is also a work, it will be covered within the sweep of section 194C, and therefore the scope of section 194C is not restricted to work contracts only. The matter did not rest at that. The CBDT came out with two circulars to interpret this decision of Supreme Court and opined that having regard to the decision of Supreme Court, any kind of contracts will be covered within section 194C. And when they came out with the circular, they even included the expression service contracts to be also falling within the sweep of any contract for any work under section 194C. These circulars were challenged by assessees across the country in different high courts, and I'll be dealing with the decision of jurisdictional Delhi High Court in the case of SRF Finance 211 ITR 861, which currently holds the field since it remained unchallenged in Supreme Court, where the Delhi High Court struck down these circulars to say that the ratio of the decision of Supreme Court was not to cover every kind of contract, and that decision was wrongly interpreted by the CBDT in its circulars 666 and 681. The Delhi High Court said that contract, given the intent of section 194C, we need to draw a distinction between contract for carrying out any work and a contract other than a work. A contract for carrying out any work for the purposes of section 194C means a contract which involves more of a tangible output. It is a contract which can be executed through physical labor. and may not be really intellectual. So they drawn a distinction between an intellectual work and a non-intellectual work comprising more of a physical labor or a tangible output. So on that basis, the Delhi High Court held that the contracts for services which would involve more of an intellectual skill on the part of the contractor will be outside the ambit of work contract for carrying out any work under section 194C. And therefore 194C will be only restricted to these kinds of contracts, and the contracts involving intellectual or skill on the part of the contractor will be outside the ambit of 194C. And this decision was again reiterated by Bombay High Court in East India Hotels 320 ITR 526, and these decisions, friends, presently hold the field. So therefore, whenever a contract comes at the table of the SSC as to decide whether the TDS rate of 194C will be applied or TDS rate of 194J will be applied, I'll deal with 194J subsequently, but we will need to see whether 194C is applicable or not if it does not involve intellectual input, and if it is more of a physical contract, a contract which needs to be just executed by the contractor, that will more fall within the domain of 194C. So this is, friends, how we need to distinguish between a work contract and a contract other than work or service contract. Moving forward, friends, one of the very important issues which was even raised by Mr. Chopra in his opening remarks was TDS on reimbursement of expenses. Why, whether or not one needs to deduct TDS on reimbursement of expenses, when, and it could cover two kinds of situations: when a composite bill is raised by the contractor or a service recipient for its out-of-pocket expenses, or for reimbursement of expenses, or he raises a separate bill. Friends, and this issue, friends, is common for all the three provisions which I am discussing today, that is 194C, 194J, 194H. And I'll tell you how. Why this is common. Because when we see all these sections, there's a common phraseology used in all these sections which says that TDS has to be deducted of such sum as income tax on income comprised in the relevant payment. Income comprised in the relevant payment. So therefore, the section itself says that tax is to be deducted on the element of income comprised in the payment made. And the law with respect to the meaning of word income is fairly well settled, that reimbursement of expenses does not constitute income of the recipient. So taking clue from that, if the payment made does not have any element of income, then the provisions of TDS are not attracted. And therefore, if a payment is made for reimbursement of expenses, having regard to the principle of law that reimbursement of expense is not income and TDS has to be deducted only on the income element, the section is not attracted on reimbursement of expenses. That is when we read the section barely. But we have a CBDT circular. Circular says in a reverse manner, and it says that if a gross bill is raised, which comprises of claim for reimbursement of expenses, then the deductor is not to exclude the portion of reimbursement of expenses for the purposes of TDS. And this is circular number 715, dated 8/8/1995, question number 30. Now, this circular has also come on test before the various courts and tribunals across the country. When we reconcile the decisions of the court and the CBDT circular, the position that is how reconciled is that if it's a composite bill and the contractee or the recipient has raised the invoice for his service charges as well as the claim for reimbursement of expenses in the same invoice, then the circular is attracted and therefore TDS may be deducted on the entire amount. But if he raises a separate invoice for his service charges and a separate invoice for the expenses, which is backed by the actual expenses incurred by the recipient, which leaves no iota of doubt that there is no income element in the claim raised for reimbursement of expenses, only in that situation, no TDS ought to be deducted on the reimbursement portion. If there is an iota of doubt, you do not have proof as to what is the income element comprised in the reimbursement of expenses. You do not have proof of actual expenses incurred by the recipient, then erring on the side of caution, it would be advisable not to steer away from deduction of tax at source. Better be cautious and deduct tax at source even on the claim of reimbursement of expenses. So this is, friends, what is how we should deal with the issue of reimbursement of expenses. Moving forward, friends, the next topic which I'm taking for TDS provisions is provision for expenses, which comes up as a controversy day in and day out. When we see companies who are following mercantile system of accounting, it is a standard practice that we create provision for expenses which are incurred during the year in order to cull out the real profit earned during the year, to cull out to report the real expenses incurred during the year, maybe for the purposes of MIS or for the purposes of proper accounting of income earned by the company during a particular year. So as we record the provision for expenses in the books, the issue arises whether the company need to deduct TDS on this provision aspect. Friends, the issue as to whether we need to deduct TDS on a provision depends upon whether that provision is a provision of an unascertained liability or an ascertained liability. If the provision is of an unascertained liability means that it is an ad hoc provision and pay is not identified. I have just estimate that yes, so if it's a large company, there is an estimation comes from various works or from various departments that this is our estimate of expenses incurred during a particular month and during a particular quarter, which is not backed by the name of the payees and the exact amount payable to the payees. We call it an unascertained liability. If it's an unascertained liability, which is reversed subsequently on receipt of actual bills and name of the payees, then this expense is per se first not allowable as a deduction under the provisions of Income Tax Act, being a provision for an unascertained liability, and parallelly there will be no obligation to deduct tax at source on this provision for unascertained liability. And the answer and the legal answer to this debate lies in the expression income comprised therein, which I just explained while discussing the issue of reimbursement of expenses. Because when we create a provision for unascertained liability, it does not constitute income in the hands of the recipient also. It's a unilateral provision created in the books of the company, which does not create a corresponding income in the hands of the recipient. So it is an ad hoc provision. It does not constitute income in the hands of recipient. The payer is not even aware of who is the actual payee, what is the actual amount payable to the payee. When all these conditions are cumulatively satisfied, then a conclusion can be drawn that TDS ought not to be deducted. But suppose the position is reverse. Any of the condition is satisfied, and the one argues that it is a provision for an ascertained liability in as much as either the payee is known or the exact amount of expense incurred is known, then merely because I have debited the expenditure to the provision account, I cannot escape my obligation to deduct tax at source. And the answer to that also lies in various provisions of section 194C, J, H, wherein it has been categorically stated in the section itself that there is no escape from TDS obligation, even if the recipient's account is credited by an account name of a suspense account and not to the recipient's account. So the position of a provision is something akin and clearly falls in the embargo couched in the respective provisions, that even if an expense is credited to a provision account, there is no escape of TDS obligation. But in that situation, friends, we need to differentiate between whether we are making a provision for an unascertained liability or an ascertained liability. I repeat, if it's a provision for an unascertained liability, it's an ad hoc amount, payee is not known, I've just debited an expense for the purposes of MIS or for the purposes of accounting, then there is no TDS default, there is no default of TDS. But if it's an ascertained liability, even if I've credited to provision account, I know who the payee is, or I know at the back end that who is the one who has incurred the expenditure, and who is the person whom I need to make payment subsequently, then there is no escape of TDS obligation. So this is how, friends, one can decide while making a provision as to when to deduct TDS and when not to deduct TDS. And we have divergent decisions from the courts, which are again factual, where the courts have held that if the pay is identifiable, then TDS ought to be deducted. When pay is not identifiable, then TDS ought not to be deducted. Then, friends, I come to another aspect of 194C, that 194C is applicable only on work contract. We also need to make a distinction between sale contract and work contract. Many corporates, especially in case of OEMs, when a manufacturer outsources its part of manufacturing operations to OEMs, then the issue arises whether it's a work contract or it's a sale contract. And whether the outsourcer manufacturer need to deduct tax at source on payment of purchase of material from an OEM. The answer to that issue lies as to whether the contract with the OEM is a work contract or a purchase stroke sale contract. If it's a purchase or sale contract, then it falls outside the ambit of 194C. It's not a work contract. But if it's not a sale contract, then it may tantamount to work contract. What is the distinction between a sale contract and a work contract? It lies between when does the ownership of property lies either with the OEM or with the outsourcer. So we have some guidance available in section 194C itself in terms of clause 4 of explanation to 194C, which gives the definition of work. In that definition, they have tried to make a distinction as to when these kind of contracts will fall within the ambit of work and when will not fall within the ambit of work. It has been prescribed that if the OEM manufactures the products by procuring its own raw material, and then after procuring its own raw material, maybe he uses the specification of the manufacturer and supplies the product to the manufacturer, then it is in the nature of sale contract and it is outside the ambit of work contract. But if the manufacturer supplies the material and the OEM manufacturer converts that material into the relevant form and then supplies back to the manufacturer, then it is in the nature of work contract. And then in that situation, the manufacturer will need to deduct TDS on the bill raised by the contractor. And the answer lies because when the property is supplied, if I have supplied the material and he has just converted that material into the final form, then ownership in the property always remains with the manufacturer. And the OEM supplier has only carried out a work of conversion of that material into the refined form, and therefore it satisfies the test of being a work contract. Whereas if the contract manufacturer has purchased the material from third party, then the ownership in that material lies with the contract manufacturer. He produces the product in his own capacity and supplies the same to the original manufacturer. Then it comes in the definition of a sale contract, and therefore it is a sale contract and no tax need to be deducted under section 194C of the Act. So this is, friend, few nuances of section 194C and how it is different from other service contracts, and what is the nature and width of section 194C while deciding whether a contract needs to be covered under 194C for the purposes of deduction of tax at source. Friends, now I move to section 194J. The scope of section 194J is being expanded from time to time. Originally, it started with professional services. Now with time, it covers payment made for professional services, payment made for technical services, director's fee, royalty, and non-compete fee. So section is quite wide, but I'll discuss professional services and technical services. Friends, it is not every professional service that will fall within the ambit of 194J. The scope of professional is exhaustive and restricted in terms of the definition of professional service as covered under section 194J. 194J specifies that only specified professions which are notified by the board for the purposes of preparing books of account under section 44AA, only when payment is made to those professionals that section 194J will be attracted. So friends, as and when you come across as to whether or not I need to deduct TDS on a payment made to a professional, then I may refer the master guide to check the CBDT circular whether the recipient professional is covered in the list or not. Only if it is covered in the list that you need to deduct TDS under section 194J, otherwise not. Then friends, I come to the meaning of the word fee for technical services. Fee for technical services has not been separately defined under section 194J, and the section takes me to section 917, which is a deeming fiction for the purposes of deeming income accruing or arising to a non-resident. The section has been widely defined. The word fee for technical services has been widely defined in that section 917 to mean payment made for any managerial, technical, or consultancy services. So insofar as words managerial and consultancy is concerned, there is no doubt. So if I have received a service which is in the nature of a managerial service, section will be attracted. If it is in the nature of a consultancy service, section will be attracted and I will need to deduct tax at source. The problem arises in interpreting the word technical. Because technical, there is no specific further definition. Any kind of service which is received can be construed as technical. So what is the meaning of the word technical? We have some jurisprudence available on the meaning of the word technical. The landmark decision on this subject was a decision of Delhi High Court in the case of Bharti Cellular, where in the context of interconnect services being utilized by one telecom operator from the other telecom operator, the question arose whether these technical services which are happening only through the technical equipments, whether they would fall within the meaning of word technical under 917 or not. The court held that the word technical falls in the company of words managerial and consultancy, and therefore should borrow its meaning from the company of the words. They applied the principle of interpretation of nociter or sociis and said that only if there is an human element involved in the service rendered, that it will fall within the meaning of technical, and if only equipments are rendering service without any human interface, then that service may not fall within the meaning of word technical. So for a service to fall within the meaning of technical, there must be an element of human interface. A human must be involved in rendering the service that it will fall within the meaning of technical. Then friends, we came across another decision of Supreme Court in case of Kotak Securities, where the brokers were making payment to stock exchange for using their facility of doing trade on the stock exchange. So again, the question arose whether the payment made to stock exchange to avail the facility of transacting on stock exchange will constitute technical service or not. The Supreme Court gave a new twist to this controversy and held that if the service is in the nature of a standard facility, we need to make a distinction between a service and a facility. A service is sort of a customized service given by the payer to the pay, or by the pay to the payer. But if it's in the nature of a standard facility which is available to all on payment, and it is not in the nature of a customized facility or a customized service, then it will not fall within the meaning of technical under section 917. So it has to be a customized service in order to fall within the meaning of word technical and to further attract TDS provisions under section 194J. So friends, this fine nuances may be kept in mind while deciding whether invoice received need to suffer TDS under 194J or not. Lastly, friends, I'll cover section 194H, keeping my time limits in mind. I have already surpassed the time limits given to me, so I'll quickly wrap up with the last provision, that is 194H, which deals with TDS on commission or brokerage. Friends, it is not every commission or brokerage that need to suffer TDS under section 194H. The law is fairly well settled today that the commission or brokerage, which involves element of agency, when that the provisions of section 194H will be attracted. If a contract is in the nature of a principal to principal contract between the payer and the payee, then the income element, it may be nomenclatured as commission or brokerage, it will not suffer TDS. For instance, we have a decision of Supreme Court in case of Ahmedabad Stamp Vendors Association, where the government authority was supplying stamps to the stamp vendors at a discount. And the stamp vendors were further supplying those stamps to the public users and earning income by way of discount, which was offered by the government producing the stamp. The question arose whether the stamp vendors were acting as an agent or a principal to principal on a principal to principal basis. The Supreme Court held that they were stockists. It was a principal transaction of purchase of stamps from the relevant government organization, which was purchased at a discount and further supplied to the consumers. So since the element of agency was missing, it is outside the ambit of the scope of section 194H, and the discount earned cannot be considered as commission to suffer TDS under section 194H. Friends, another important aspect that frequently comes to mind is that let us take this transaction of earning of discount by the stamp vendors. There is no payment by the government who is supplying the stamp to the stamp vendor. The stamp vendor is enjoying income only by way of further supply to the customers, and the margin is his income. There is no payment by the government to the stockist, assuming there was an element of agency, but the income was by way of earning of discount from further supply to the customer. So the question was that since when there is no payment, whether the TDS provisions will be attracted or not. This issue has been recently settled by the Supreme Court in the case of Singapore Airlines, which was dealing with the case of supply of tickets by the airline agency to the travel agents. And it was held in the facts of that case that travel agents were acting as agents, and therefore income earned by them from supply of tickets to the customers is in the nature of commission. So one of the issues was that since there was no payment by the airlines to the commission agents or to the ticketing agents, whether section 194H will be attracted or not, the Supreme Court held that no, whether the payment is made or not, it does not keep the section outside the ambit, even if there is no payment made. But since the income earned is in the nature of commission, the airlines companies were ought to deduct TDS on the commission earned by the commission agents. So friends, this also needs to be kept in mind that even if no payment is made, but I know what is the nature of income earned by my agent, even in that situation, the TDS provisions will get attracted. So friends, these were the few points which I thought I'll discuss. So for the benefit of the audience, which they can keep it in mind while deciding as to when to deduct tax at source on various routine complicated issues which come to our mind, like reimbursement of expenses, provision for expenses, payment to agents, sale contract, purchase contract, etc. I hope there is some clarity on the thoughts discussed today. Over to the chairman of the session, Mr. Chopra. Thank you, sir.
Thank you, Gaurav. That was very useful. And just like the speaker thinks there is inadequate time, as chair, I'm always thinking there is inadequate time, because I know there is so much more which is interesting and useful, which we would gain if we could listen to you. Quickly, I will touch one or two points that on reimbursement, there is a decision in DLF Commercial Project Corporation that where there is no income element and no add-on, then pure reimbursement does not lead to TDS. There is also, it is useful to clarify a current decision in Surindra Commercial of the Supreme Court, where the fact that is TDS to be deducted on reimbursement, that SLP was permitted to be withdrawn with the right to file a review before the High Court. So the SLP was withdrawn. There is no final decision, though that decision is reported as if it is in favor of the revenue. So is TDS to be deducted on reimbursement or not? There is no final view on that as far as Surendra Commercial is concerned. However, there is a very important fact there. They did not have documentary evidence to show that it has been done at par.
Yeah.
Or that it is an actual reimbursement and that there is no add-on of income,
Sure.
any other charge which is there. Thank you, Gaurav. That was very interesting and useful indeed.
My pleasure, sir.
Thank you. My next speaker is Harpreet Ajmani. He will be talking to us about TDS in respect of Section 194, which is certain payments by e-commerce operators to e-commerce participants, and also on payments for purchase of goods, 194Q. Harpreet is a partner from, again, everybody we have here are from senior lead firms, and they're all extremely distinguished speakers that we have, and I'm fortunate to have them. And Harpreet is an advocate on record in the Supreme Court. He specializes in taxation. He has several years of experience in litigation and advisory, and this includes corporate tax, domestic tax, international tax, transfer pricing. He advises on cross-border investments, tax planning, structuring, and general corporate advisory matters. And he also represents his clients as a lawyer before various forums in India. He is a partner with AZB. Ladies and gentlemen, Mr. Harpreet Ajmani, please.
Thank you so much, Anil Chopra, sir. Good afternoon, ladies and gentlemen. The topic here, which I would be discussing, is the TDS applicability on the e-commerce operators in terms of Section 194O. This provision was inserted by way of Finance Act 2020 with effect from 1st October 2020. This is a very interesting provision because this provision in itself has brought a paradigm shift in the whole TDS regime in the general sense what we understand. Before touching upon 194O, I would like to highlight Section 190 of the Income Tax Act, which provides the different modes of collection of payment through which the government is entitled to collection and recovery of tax. That is, 190 says that a payment for the recovery of tax can be done either in the form of deduction or collection at source or by virtue of the advance payment. And in this scenario, the liability for doing the deposit is, in case there is any default, the concerned person is regarded as an assessee in default and would be liable for the interest, penalty, and maybe compensation in certain scenarios. Therefore, it is very important to first understand the whole structure of 194O and how it is interesting that what are the changes it has brought with itself. Because the liability under 194O is casted on the e-commerce operators. I'll take you through the different definition of the different terms like e-commerce operators, e-commerce participants, because they are the trigger points pursuant to which the levy would be imposed or the TDS obligation would be there. But interestingly, this e-commerce operator per se is neither a buyer nor a seller in the transaction. But by virtue of this deeming fiction, where under 194O subsection 6, the e-commerce operator has been obligated to discharge this obligation. At this point, I would also like to highlight that under section 2, subsection 7, there is a concept of deemed assessee. This is important because e-commerce operator by virtue of 2 subsection 7 would be regarded as deemed assessee, and any default in making the deposit, in collecting and making the deposit with the government exchequer, that would make them as a assessee in default. Therefore, the government's objective and intent as per the memorandum for introducing 194O was that they wanted to enhance the net, to widen and deepen the text net by bringing the participants of e-commerce within the text net. This is the definition, or this is the basic objective with which 194O was introduced. In this background, I would also like to touch upon the facet that whether under 194O, because this is only at the end of the day a TDS provision, this is not a charging provision, whether the legislature is competent to shift the incidence of tax and to put a onerous obligation on the assessee or on a person who's not even a buyer or a seller to a transaction, but merely by virtue of a deeming fiction, the e-commerce operators have been brought into the tax bracket, and they have been put on a additional obligation and responsibility to collect the data, collect it from the source, and to collect the source, to, to collect the data, to collect this information and simultaneously collect the TDS and deposit it with the exchequer. Therefore, the large issue which would require consideration, which has not been tested yet before the court of law, is regarding the competence of legislature to bring such kind of provision. It's untested, so I'll not comment too much on it. But this is also one of the aspect to be checked, that what is the scope of Income Tax Act, and to what extent the government's obligation to do the recovery of taxation can be put on third parties, because the provision of 194O starts with a non-obstante clause, and it says that any person and any e-commerce operator, whether it is resident or non-resident, it does not distinguish between resident and non-resident. The obligation to deduct and deposit TDS has been put on an e-commerce operator. Therefore, at this point, I'll just refer to the definition of e-commerce operator. E-commerce operator has been defined under the Act to mean a person who owns, operates, or manages digital or electronic facility or platform for electronic commerce. So it's very widely worded. Any person who owns, operates, or manages digital or electronic facility or platform for electronic purpose would be obligated to deduct and deposit the TDS with the government. Now, the trigger point is that this 194O would per se be applicable in context of the Indian sellers who are doing sale transaction on these e-commerce platforms. I'll not name it, but we all are in our day-to-day life using multiple mobile apps, as well as we are doing shopping online. And for that, we are using platforms and search engines from where we are buying these different products, buying different goods, as well as procuring different services. So all these transactions which are happening online by virtue of these platforms, in that the Indian sellers, in which the Indian sellers are involved, in that context, the e-commerce operator is liable to deduct and deposit TDS at the rate of 1%. Now, what is the definition of e-commerce participant? Because that is also one of the most interesting facets here. E-commerce participant means a person resident in India selling goods or providing services, or both, including digital products, through digital or electronic facility or platform for electronic commerce. The term electronic commerce is also defined within this section only. Electronic commerce means the supply of goods or services, or both, including digital product, over digital or electronic network. So there are, as far as 194O is concerned, it has to be read in a way that it is not linked to the income of any individual, and shall be applicable irrespective of any liability to tax being cast on these sellers. yes, under 194.02, the relevant individuals and HUFs whose income is less than 5 lakhs have been granted exemption from to the e-commerce operators are not required to deduct TDS in those contexts. However, simultaneously, even in the category of individuals and HUFs whose income is less than 5 lakh, the e-commerce operator has to keep their record by taking their PAN card as well as Aadhaar card or their Aadhaar card and maintain that data. So a very onerous responsibility has been put on e-commerce operator, although they are not directly involved in the transaction per se, nor they would be earning any income as far as this transaction is concerned, apart from the general commission or other sources of income which they may be having, but not qua the direct transaction. So in a way, the government has expanded the tax net of the collection of TD of tax at source, and this in a way is a very innovative step of increasing the tax net. Some of the important facets or the key factors, what I feel, since there is not much jurisprudence on 194.0, since it's a new provision, how I would interpret 194.0 is that the first requirement is that there has to be a e-commerce operator, because even within the MNCs, we are seeing that the companies in India may be using their own internal software, maybe just for the purpose of intra-group services, where a common platform is there. It's a very common practice that MNCs are using a common platform within the group, and they would be placing, an Indian entity would be placing order as far as uh, for procurement of good or for procurement of services. But the larger issue would be that whether 194.0 could be triggered even on those aspects. There is not much precedence, but to my understanding, yes, considering the open-ended language of section 194.0, once the trigger point of that the person who's placing the order is the e-commerce participant, being an Indian resident, is placing an order even on the internal platform of the group, may qualify may qualify for the purpose of 194.0, and maybe a group entity which is placed outside India would be owning, operating, or managing the website or the electronic platform, would be obligated to deduct TDS, although there may be no direct transaction per se, and it's only a within the group transaction. So 194.0 per se has a very vast ramification as far as these kind of transactions are concerned. Other example, other key factor would be that this e-commerce participant has to place has to the provision of goods, the selling of goods or provision of services has to be through the digital electronic facility or platform. Because uh, as far as, let's presume a transaction where I go on a website, place a order for just buying some clothes, and thereafter I select the option of cash on delivery. So in this scenario, the payment will directly go to the seller's pocket. But even in this kind of scenario, there is an obligation of e-commerce operator that it has to deduct TDS at source, and this point is covered under subsection under the proviso to 194.0 in form of the explanation, which say that by virtue of a deeming fiction, it says that uh, once the transaction is happening through the platform, the electronic platform, so irrespective of the fact whether the payment has been made directly by the buyer to the seller, even in that kind of scenario, the electronic operator would be obligated to deduct tax at source. So it's a bit onerous on the part of the e-commerce operator, that first they have to maintain data, they have to even discharge the obligation where they are not even involved as far as these transactions are concerned. And therefore, considering the ambiguities involved, the CBDT has issued some circulars. I'll just touch upon them in a short while. But there is a wide ramifications which are involved. And at one place, Government of India is promoting that engineers and everything should be done online, and at the same point in time, these kind of onerous things are also there. So there has, to my understanding, there has to be a balance maintained between, yes, facilitating the government and for increasing its tax net, plus simultaneously, no prejudicial conditions should be imposed on a business which may be onerous for its development and growth. So this is one aspect. The second aspect is that for the electronic commerce transaction, the even if the amount is credited or paid at whichever incidents happened first, the obligation to deduct TDS will happen at that point in time. Uh, the the next part is that as far as the exclusions are concerned, by virtue of the CBDT circular, certain exclusions have been highlighted, considering the difficulties or the practical challenges which were faced by the business, and then they have approached the CBDT for clarification. One such, so in terms of circular number 17 of 2020, that is dated 20th September 2020, CBDT has clarified uh, that the transactions, the the transaction of sale of goods or provision of services, which are happening through exchanges like stock exchange for securities and commodities, they are outside the purview of 194.0. Similarly, the transaction in electricity, renewable electricity certificates, and energy saving certificates traded through power exchanges, they are also posed outside the purview of 194.0. The next exception category, what CBDT has clarified, is in context of payment gateways. That whenever we do a transaction through through a platform, electronic platform, naturally for the purpose of making payment, we are using a payment gateway. And a payment gateway, like there are multiple payment gateways, or even our bankers are providing this facility. So in these payment gateways, just to avoid duplication of 194.0 being triggered, once at the level of marketplace, that is e-commerce operator, and second at the level of payment gateway, to avoid this double incidence of taxation, CBDT has clarified that if the payment is made or TDS is deducted under 194.0 at the level of marketplace, then there is no need for duplication at the level of the payment gateways. So the payment gateways have been excluded. The next category is that 194.0 shall not be applicable on insurance agents and insurance aggregators. So practically, the insurance agents and aggregators, they are involved at the first limb, or when the policy is being purchased, their main role is at that level. Thereafter, the premium is directly paid by to the insurer. So in this context, the CBDT has clarified that the insurance agents and insurance aggregators, they would be outside the purview of 194.0. So these kind of clarifications have come in, but still there is a lot of scope and the ambiguity is still there. And one of the interesting facets is regarding interpretation of 194.0 subsection 3. 194.03 says, and it gives a overriding effect to, by virtue of a non-obstante clause, it gives a overriding effect to the application of 194.0 vis-a-vis other provisions in of deduction of TDS in part B of chapter 17. And by virtue of that, it says that whenever a TDS has been deducted under 194.0, or in terms of subsection 2, where a particular transaction is exempted just on account of being within the range of less than 5 lakhs and being a case of individual and HUF. Now, apart from these two exceptions, the provisions of 194.0 would have an overriding effect as far as the other provisions are concerned. Simultaneously, the proviso to subsection 3 also give a very important benefit. How I would read it is that it says that the provisions of this subsection shall not apply to any amount or aggregate of amounts received or receivable by an e-commerce operator for hosting advertisement or providing any other services which are not in connection with the sale or services referred to in subsection 1. The significance of this limb is that assuming that the e-commerce operator along with the general market platform what it is providing also gives additional services to the seller, like in the nature of warehousing or in the nature of storing or maybe in the nature of transportation of goods. So in terms of proviso to subsection 3, since this would not have a direct connection vis-a-vis the transaction of buy and sell of on the platform, and therefore the word in connection with as used in the proviso has to be read, a purposive interpretation has to be given that 194.0 would not be applicable as far as these additional transactions are concerned, where the main transaction would be between the seller and the e-commerce operator who may be providing some additional services. So the contractual arrangement or the privity of contract, as we say, the privity of contract and qua these additional services would be between the e-commerce operator and the seller. So these kind of transactions would be excluded. This is how I would read the proviso to subsection 3. And to that extent, it could be a beneficial provision where 194.0's applicability has to be confined to the transactions which are in relation to the sale of goods or provision of services which are happening on the marketplace. So this would be one of the element how I would read the proviso. I've already highlighted that by virtue of subsection 6 to 194.0, the deeming fiction is there, where the e-commerce operator shall be deemed to be the person responsible for paying to e-commerce participant. The objective of inserting subsection 6, the legislative intent is that they want to cover e-commerce operator within the purview of the deeming fiction, which is there in section 2 subsection 7, where the inclusive definition of assessee is there, so that in case there is any default on the part of the e-commerce operator in deducting and depositing TDS, they may be held responsible. The next point what I would like to highlight is that even the term e-commerce has to be, since although it is a defined term, but it has to be understood in context of commercial sense, how a business is being run and a business is being carried out. So in that background, a person means supply of goods or services or both, and that transaction has to be through the platform. The through the platform is very important because again there was some ambiguity in terms of e-auctions, where the e-commerce platform or the marketplace was used only as a via mode, where the platform was used as a only for the purpose of bidding and only for the purpose of auction, but rest of the transaction was not happening on the marketplace. So again this issue went up to the CBDT for getting a clarity on how a transaction of e-auction would be whether it would be covered under the purview of 194.0 or not, where the transaction per se is not concluded on the marketplace. So in that context, CBDT, by virtue of circular number 20 of 2021, has given a clarification. They have pointed out 6 instances which are to be jointly satisfied, where the whole objective of e-auction, which is happening on the marketplace, was restricted to price discovery. So the contract was not concluded on the marketplace, but only for the purpose of price discovery, the marketplace was facilitating the buyer and the seller to come on the platform and just utilize the service, but conclusion of contract was not there. So that is first condition. Second condition is that whether there was a discretion of the client to accept the price or directly negotiate the counterparty. Third condition was whether the transaction of purchase of sale takes place directly between the buyer and the seller, partly outside the electronic platform maintained by the e-auctioneer only to act as the starting point for negotiation and conclusion. Next is whether the e-auctioneer is not responsible for facilitating the purchase of and sale of goods for which e-auction was conducted on its electronic platform. The next condition is that payment for the transaction are carried out directly between the buyer and seller outside the electronic portal. And the last condition is for payment made to the e-auctioneer for providing e-auction service, the client deducts tax under the relevant provision of the Act other than 194O. If all these conditions are simultaneously fulfilled, only in that kind of scenario, the e-auction would be outside the purview of 194O. The next interesting point is that although by virtue of these circulars, purportedly clarifications have been given that how 194O may not be applicable, but as we were just referring to the relevant 6 conditions, still there has to be some degree of obligation being there in under the other provisions. So if a particular transaction is taxable under 194C or other provisions, if that is satisfied, then 194O would not be applicable. But in other cases, 194O may still be applicable. So this guideline still, there is a lot of ambiguity to my understanding, and it still leaves a room of the factual exercise. Now, whether CBDT has in a way given a complete blanket clarification on all the e-auctions being exempt from the purview of 194O, or it would be subjective, because still it would be a factual exercise. Next point, which I would just like to highlight is that although the provisions of 194O, there is no clarity whether it would be applicable qua non-resident or resident. Once, as far as who is the e-commerce operator, it could be a resident as well as non-resident. So the compliance burden is quite high. This is all as far as 194O is concerned. Now, I would like to touch upon the second aspect, the second part of my topic, that is TDS under 194Q. 194Q deals with deduction of tax at source on payment of certain sum for purchase of goods. Again, the trigger point here would be the objective of this provision was to provide for TDS by person responsible for paying any sum to any resident for purchase of goods. The obligation has been casted on the buyer that at the stage of making the payment, it has to deduct tax at source and at the rate of 0.1% for all transactions beyond the 50 lakh. This particular provision would be applicable, and it would be in context of the sellers whose total turnover is more than 10 crore in any financial year preceding the financial year in which the transaction is happened. So just to put it in terms of the ingredients, any person being buyer responsible for paying any sum to any resident for purchase of any goods of value or aggregate value of goods exceeding 50 lakhs at the time of credit of such sum to credit or payment to seller by any mode. So it can be by any mode, but the obligation is that the buyer has to deduct TDS, and the threshold of buyer is that if its turnover exceeds 10 crore. Normally, if we look at the provision holistically, it would be applicable in context of a business to business transactions, because the kind of threshold which has been imposed and the rate of TDS which is envisaged, this shows that the objective of government for introducing 194Q, which was inserted by Finance Act 21 with effect from 1/7/21, was just to increase or broaden all the transactions which are high valued, and to bring it within the notice or within the record. So it is more from a recording perspective rather than collection perspective, because 0.1% per se may not be a sufficient consideration for that the whole obligation in the hands of the seller is met. Uh, there are again like 194O, the same kind of exemptions or exclusions are there for 194Q also, like for securities exchange, and even for the purpose of electricity trade and all these things. Similar provision or similar clarification was brought in by CBDT even in context of 194Q. Since considering the rate which is there, in terms of 194Q, the TDS is, if TDS under 194Q shall not be applicable, where TDS is deductible under any other provisions of the IT Act, or TDS is collectible under section 206 other than the transactions covered under 2061H. So there is an exclusion that 194Q per se may not be applicable where any other provisions of TDS is applicable or 206C is applicable. However, 206 C1H has been excluded because even the TCS provision under 2061H provide for 0.1% rate, and similarly under 194Q also the same rate is there. And for this purpose, even CBDT has brought in two circulars giving clarification on this. Under circular number 13 of 2021, dated 30th June 21, this kind of transaction has been clarified that in terms of applicability of 194O, 194Q, and 206C1H, because in all these transactions, the trigger point is that resident is an Indian, the seller is an Indian. So considering the broad base being the same, there was a need for clarification that in case where there is an overlap between between these three provisions, 194O, 194Q, and 2061H, 206C1H, which one will prevail, and what would be the sequence of compliance, because none of the assessees would like to be a assessee in default. So the CBDT has clarified that in terms of sequence of giving priority to all transactions which are happening through electronic commerce, and there is an obligation of e-commerce operator, the precedence would be first given to 194O, and the provisions of 194Q and 206 C1H would not be applicable. Thereafter, in terms of priority, the provisions of 194Q would be applicable, and then 206C1H would be applicable. Further, even in context of the CBDT has also given some clarifications on other aspects regarding applicability of 194Q, and it has provided, as Anilji was referring in the initial phase, that the GST element is to be excluded because there is no income element on the GST component. So for that purpose, in circular number 13 of 2021, it is clarified that section 194Q would not be applicable where GST, as far as the GST amount is concerned in the total invoice. So let's say an invoice of 100 rupee has been raised, and the GST component on that is 2 rupees. So the TDS obligation would be only to the extent of 98 rupees, and no TDS would be applicable on the 2 rupee component, that is the GST which would be there. Then other clarification what CBDT has given is that as far as the transaction of purchase returns are there, there CBDT has said that those are to be adjusted if, let's say, a party is dealing with the same party and it's a recurring account. In that kind of scenario, the purchase return is to be adjusted against that party's ledger and against the sale made to the same party, and no adjustment is required if purchase return is replaced by the goods by the seller. So in a way, the CBDT's clarification is restricted only when it is assuming that the transaction is recurring with the same seller, or where the goods are being replaced. However, the circular is silent on the aspect where it is a one-off transaction and it is not recurring in nature. So there is no clarity on as far as CBDT circular is concerned on that aspect. Then other clarification what CBDT has brought is that in context of non-residents, because 194Q again starts with any person. So since any person responsible for providing to a resident, so the buyer could be either a resident or a non-resident. So there was an ambiguity that whether in case of a transaction with non-resident being the buyer and the seller is an Indian entity, how the provisions of 194Q would be applicable. So in that context, CBDT has clarified that this 194Q would be applicable only when the the transaction of sale is related to the permanent establishment of the buyer in India. It would not be applicable where the buyer or the transaction has no nexus with the permanent establishment of the buyer. So in a way, it is a good clarificatory thing that although it is a settled position that a buyer would be responsible, or the permanent establishment, the transaction on account of permanent establishment are only to be seen as far as non-residents are concerned. But yes, it's a very welcome move that CBDT has clarified it in so many words that as far as buyers are concerned, the provisions of 194Q would be applicable only to the extent of permanent establishment. Another reason for bringing this clarification is that the business purpose or the commercial exigency is one of the basic facets or a sine qua non for the applicability of 194Q. If it is not a business or commercial transaction, the provisions of 194Q would not be applicable per se. So in that view, the CBDT circular has just clarified the position further. The next is 194Q would not be applicable where income of the seller is completely exempt. As Anilji was saying in the initial phase, that as far as the transactions which are per se exempt, all the TDS provisions, there should be a clarification that why to burden an assessee with that onerous responsibility when the transaction per se is exempt. So this kind of clarification is already there, circular number 13 of 2021 in context of 194Q. I think CBDT should bring in more similar kind of provisions or similar kind of clarifications in context of even the other provisions which are exempt or are not subjected to tax under the provisions of the Act. Uh, then the next clarification which has been brought in by the circular number 20 of 2021 that's dated 25th November 2021, it is mainly in context of the Department of Central and State Government. CBDT has clarified that where there is no element of business or commercial activity, 194Q would not be applicable to these agencies, and they would not be regarded as buyer. Simultaneously, they have also clarified that central government and state government department may per se not be regarded as seller. So the objective is very clear that they want to exclude the central and state government from the rigors of 194Q. Considering the time, I'll just wrap up that 194O and 194Q, the objective of both the provisions is very clear that the text net has to be broadened. But along with it, considering the far-reaching consequences it has and the kind of magnitude which would be involved in terms of the local sales, because the targeted sale, that the income would be of the seller, the Indian seller, who would already be subjected to tax under, would be eligible for taxation under the provisions of the Act. So the moot point would be that it would be in the interest of the assessee as well as the department that more liberal interpretation is taken for 194O and Q regarding its applicability and regarding its functionality, because there is a lot of ambiguity that these kind of transactions, because the scope is very wide, I per se see that there is a lot of litigation which may happen if the department is going to go into the nuances of its applicability, because the data is to be maintained by, in context of 194.0, by the e-commerce operator. It depends on their resources, their ability to maintain this kind of resources and to do the compliance also to that extent. So the thought process is good, but there are a lot of challenges, and therefore it would be very important for CBDT to come up with more such clarifications that how 194.0 and Q can be implemented. That's it from my side, Anilji.
Thank you very much, Harpreet. That was brilliant and extensive and clear. And that too on provisions which are comparatively new, and there is much water which is going to flow yet on these provisions. I think one of the aspects you have brought out is the compliance complexity. And that is something that needs to be watered down. We are a nation committed to ease of business. And if the income is of somebody, deduction is of somebody, detail is kept in a certain way, and then you collect tax, then you refund tax, there are going to be aspects that need consideration. To what extent will an annual information return, not that that is a non-compliance, not that that does not entail records, but to what extent will annual information return data and filings permit the government to have the record which will promote compliance? But you know, it is also said, and we all believe, that simplification of the tax provisions and rationalization also leads to better compliance. And then there are inadvertent errors which have other consequences. So these matters do need to be looked at further. Do we have other solutions? In practical implementation, there are so many aspects, and you have touched very extensively and nicely various parts of this. But if I continue in the same fold, what about amounts? How do you define gross turnover? What is the exact definition of gross turnover? What happens when you make a sale? There are deductions and involvements, and then there is a sales return. What about sums of money which are held back? How is those sums to be treated? What about at the time of sale or subsequently rebates and discounts? What about, you know, various incentives that may come into play and other provisions which relate to incentives? I can go on and on. And then the impact on liquidity. You are touching upon this also in the overview, that what is the margin? Based on the margin, what is the amount of TDS in proportion? And then, you know, in such businesses, there are very fine sums which are involved as margins in the real operation. And if from those fine sums, you take away cash flow, the whole liquidity takes a sea change. It is material. It is significant. So, and we want to promote business. It is nobody's doubt that at the end of the day, business creates income, creates tax. So that business has to be promoted, and that will be done. And I'm sure what very learned people like you who have every good intention and constructive intention, what you are saying will be heard in the right places. Thank you very much indeed. Yeah. My next speaker is on a wide subject. We could have a whole webinar just on that subject. Actually, many of these, I could have a whole webinar just on that topic. And that subject is tax at source on income of chargeable to tax in case of non-resident, section 195. And again, I have a brilliant and learned speaker, a good friend of mine, Mr. S.R. Patnaik, whose partner and national leader tax, Amarchand Mangaldas. Mr. Patnaik has more than 25 years of post-qualification experience, specializing in various aspects of direct and indirect tax. This includes international tax, transfer pricing, corporate tax, and GST. He's a CA and a lawyer. So, if I may say so, he has a more comprehensive understanding of matters as a CA and lawyer combined. He has been featured as one of the leading tax controversy leaders in India by International Tax Review, highly prestigious. His expertise is wide and deep, and the actual experience for preeminent clients has only added to it. The experience is cross-industry, various industries are involved, and he does appear and advise for various forums. This includes Tribunal, High Court, Supreme Court, and he is also involved regularly with senior counsels for various matters. Very ably and very justly, highly merited, he has received several accolades and awards, having been nominated as a leading tax lawyer repeatedly in various forums and institutions. Ladies and gentlemen, Mr. S.R. Patnaik, section 195, please.
Thank you, Mr. Chopra, and thank you all at PSDCCI for giving me this opportunity to share my views. Ladies and gentlemen, my topic here is, what are the withholding tax obligations or, TDS obligations in respect of payments made to non-residents. Now, this issue itself is a very, very wide issue because unlike other provisions that we have discussed so far, which results in, kind of withholding only if a particular payment falls within a category, whereas this is actually an all-pervasive section. And, whether a particular income is subject to withholding or not will have to be determined on the basis of whether this is going to give rise to any taxable income in India or not. So I think, the issue that we need to debate and, discuss over here is to ensure that, what are the elements that we need to keep in mind and what are the other provisions that we have to, have within our perspective to understand how the withholding obligations arise and how best we can try and justify. This issue has become even more critical in today's context because of increased participation of multinational entities in India. Whenever they have to make any investment in India, they are worried about what could be the potential tax outgo in as and when they receive any income from India, which can be either by way of dividend or by way of interest or by way of some income in the nature of fees for technical services or royalty, and also at the time of when they exit, what would be the capital gain consequences for them. So we will try to capture some of these elements, and considering the paucity of time, I will try to just highlight some of the important aspects, and then I'll be happy to take any questions that you may have. So what are the elements of section 195 that is relevant? These are critical aspects because it kind of covers a whole range of issues. It applies to any person who can either be a resident or non-resident. There had been a dispute with regard to whether it is applicable only for residents or it also applies to non-resident, because when a non-resident receives income from another non-resident, generally Indian bank accounts are not even impacted or affected. Therefore, whether such a transaction would attract any kind of withholding requirement in India is a matter that has been debated and disputed for a long time. The Supreme Court, in fact, in the famous Vodafone decision, had specifically stated that, look, this provision should not be applicable to non-resident, it should only be applicable to residents. And the reason for that, they had tried to, go through the various provisions of, the various other withholding provisions, and clarified that, a literal construction of the words, any person responsible for paying, as including non-residents, would lead to absurd consequences. A reading of sections 194A, B, C, D, E, I, J, along with sections 115 BBA, 194I, 194J, would show that the intention of the Parliament was to first apply 195 only to the residents who have a tax presence in India. So I think, and from there, the Supreme Court proceeded to comply, to conclude that it is not required for a non-resident to, carry out such very wide implications, because as you would appreciate, the consequences of, not withholding as per the applicable provisions is pretty severe. And which we will get to know in the later part of the seminar. I don't want to encroach upon my co-panelists' view, but the consequences are very severe, and therefore one has to always be absolutely clear when they are making any payments to a non-resident, whether or not to withhold tax. And therefore, the Supreme Court was of the view that, okay, we should not try to further burden a non-resident with withholding obligations. However, this kind of issue was taken away from the taxpayer's perspective because of this change that was introduced in Finance Act 2012, along with the broader, with the Vodafone related indirect tax related tax implications. So, as you would know, in the case of Vodafone was acquiring stake of, the then existing telecom company in India, and they were buying shares from Hutchinson SR, which was a Hong Kong-based entity. But because the transaction was happening outside India, it became a major concern, and this kind of complicated India's position as a favorable tax jurisdiction for foreign investors a big way, and therefore the government was forced to retroactively change those positions. But I think the broader context is, age of today, if there is a non-resident who's either buying shares or making any payment to another non-resident, which is subject to tax in India, then unfortunately the requirement is you have to withhold tax, and you have to comply with the entire withholding provisions. Now, the second aspect is responsible for paying to a non-resident, which by itself is pretty clear that whenever you're making any payment to any non-resident. Now here, the important point is payment for responsible for paying to a non-resident. So even if you are making payment to an Indian branch of a non-resident, it would still be regarded as a non-resident, and therefore there is an obligation for you to withhold the tax. So this is one aspect that needs to be kept in mind. The next one is the most important one. Any sum chargeable to tax in India. What is chargeable to tax in India? Now earlier the issues were there were certain tax and exemptions, there were certain tax benefits that were granted to several sets of investors, whether in the form of capital gains like Mauritius, Cyprus, and Singapore, or it was in relation to some other aspects like the earlier definition of fees for technical services under the India-Mauritius Treaty was pretty favorable to the taxpayer. But over a period of time, the government has been trying to constrain non-residents to get any income from India without suffering any incident tax. So that has become a very, very significant point. So whenever we advise foreign investors, they are always worried about taxes, because one is what is the amount of tax that they need to pay. That is one aspect. But the more important aspect is most foreign investors are of the view that India's tax system is extremely challenging because the tax authorities are always trying to extract some steps. We have a lot to still achieve, because if you look at the litigation that is going on, a large part of the litigation is concerning the public sector undertakings. But next to the public sector undertakings, the major amount of litigation that is currently pending is in relation to non-resident taxation, whether it is in the form of whether you have a permanent establishment or not, or it is in relation to withholding related obligations. So we will have to act very, very cautiously if we want to improve upon our position as as a favorable tax jurisdiction, over and above I think ensuring that there are not many pending tax litigations only for the sake of it. Rather, we are only focusing on some broader, larger points where the basic issue of taxability is under dispute. The other part is tax to be withheld at the rates in force, which again is an important criteria, because what is the rate in force in relation to each and every payment? When are you going to calculate the tax amount? How are you going to calculate the tax amount? And what is the amount of withholding that you need to make? Because please understand that this is not only the provisions of the Income Tax Act that you need to keep in mind. You will also have to look at the corresponding double taxation avoidance agreement, because again, as per section 92 of the Income Tax Act, you have the ability to claim either the rates provided under the act or under the treaty, whichever is more beneficial to the taxpayer. So it's a very, very critical and important aspect, because what we are going to look at is the rates in force at the time when the payment is being made. But how would you determine the tax rate in force? Because there may be a separate rate under the Income Tax Act, there may be a separate rate under the tax treaty, there may be a subsequent amendment to either the act or to the treaty or to the domestic laws of the foreign investor or the recipient of income, and therefore what could be the relevant rates in force? That is going to be another important aspect. And the last one is payment or credit, whichever is earlier, which is a standard position from an Indian tax perspective, because as you would know, all Indian corporates are required to follow a mercantile basis of accounting, and therefore whether I make an entry in the books or whether I actually make the payment, whichever happens earlier, I am under the obligation to withhold tax. But this becomes very, very critical when you're talking about in the context of a non-resident, because what is the amount that you are going to credit against the non-residents' income at what point of time? Because even if you don't make the payment, if you're required to withhold tax at an earlier position, then not only you would have to discharge the withholding obligations within the specified time period, but also you will have to ensure that the foreign recipient also gets the credit in his or her home's jurisdiction, where in respect of this tax. So if there is a mismatch in terms of the payment or credit, then the non-resident will have to also ensure that they get all the relevant documents to establish that this payment has been withheld in respect of that particular income so that they can claim the benefit. Now, what is important is, why the requirement is to withhold the tax, because I think, according to the justification provided by the CBDT by their circular number 152 dated November 27, 1974, was that one, you get the income, you get the tax collection at the earliest. Second, it ensures that there is no difficulty in terms of collecting the taxes, because what happens is the non-residents may or may not have any assets in India, and therefore, if the tax authorities decide to proceed against the non-resident, they may not be able to claim anything. And everybody recognizes that it is going to be extremely difficult if you are trying to collect taxes from a non-resident outside India, without having any kind of legal support in that home jurisdiction, because what you need to do is you need to involve multiple ministries, and then you will have to ensure that all the taxes, the notices are served in the in a proper way, so that the non-resident also has the ability to answer, and the non-resident may also try to start litigating against you in their home jurisdiction, where you do not have the ability to actually go and contest unless you are willing to spend a significant time of amount of money, energy, and bandwidth to proceed against each and every non-resident in their home jurisdiction. And also, it is equally important that you are able to collect the money while the payment is being made, or in fact, the law requires the payer to actually recover the tax and deposit it with the government treasury before the payment is made to the non-resident, so that the government does not have the does not have to actually follow up subsequently recover the money, which always becomes a very, very challenging task. Now, the issue that we are trying to determine here is, what is this? What is the meaning of this term? Any other sum chargeable to tax? Now, again, as we discussed a little while back, Vodafone became like the almost the standard to which Indian tax authorities were being held by the non-resident investor and the recipient community, because it was a case where the Indian tax law was not clear. The Supreme Court, in fact, decided in favor of the taxpayer, that was Vodafone, that Vodafone did not have to withhold the tax when they made the payment to acquire shares of the Indian telecom company from Hutchinson. However, because there was a retrospective tax amendment that was introduced in 2012, that changes the complete paradigm. And now the requirement is to ensure that any non-resident who's making payments to another non-resident will have to first ascertain whether or not it is going to be subject to tax in India or not. And also, Vodafone introduces a newer concept that even if the transaction is happening outside India, where the Indian entities are completely untouched, and they have nothing to do with it, but still, because the parent entity's shares are transferred, and if the underlying assets are located in India, then that would still give rise to a tax incidence in India. Now, like Mr. Chopra was talking about during his introduction about significant economic presence, the issue becomes even more complicated and complex, because at the time when the transaction is undertaken, neither the taxpayer knows, here the taxpayer could either be the payer or the payee, because neither party would know whether or not the non-resident recipient had any kind of significant economic presence in India, whether the non-resident has any kind of a permanent establishment in India, or whether the transaction involving transfer of shares or any other interest revolves around transferring a beneficial interest located in India. Now, in all these situations, there is a technical liability on the on the payer to withhold the tax while making any payment to the payee. Now that changes the requirement in a significant way, and therefore it creates lots of complexities with regard to how to do a transaction to ensure both the payer and payee is happy. We have been involved in numerous transactions involving multinational enterprises, and withholding issue has become one of the most challenging aspects in relation to any such transaction, even when it involves transfer of two foreign entities outside India between one non-resident and another non-resident having nothing to do with India. If one of the entities value is derived out of assets located in India. So this is an extremely important point. When we are talking about the charging sections of section 4, 5, read with 9, this is actually the issue that we would have to ascertain and determine, because while doing the transaction, you might be thinking that, okay, it has nothing to do with India, nothing is happening in India. There's a non-resident company who is transferring its shares to another non-resident. No money is being routed into India or from India or to India. But even then, there could be a potential tax liability in India. So that's a very important and significant point that will have to be kept in mind. The other issue is, whether you need to comply with the rates defined under the Income Tax Act or under the DTA. Now here, fortunately, the circular number 728 dated October 30th, 1995, the CBDT has clarified that, okay, you have the option and opportunity of withholding tax after taking into account the provisions of the tax treaty. But still there are disputes around it, and we will discuss it a little bit later in terms of what could be the potential issue. The other important aspect is the amount that is chargeable to tax. How do you determine that? Because the section says any person responsible for paying to a non-resident any interest or any sum chargeable to tax in India. Now here the relevant issue is any sum that is chargeable to tax in India. Now, how do you compute that? So one is the nature of payment, the other is the quantum of payment, which is going to be subject to tax in India. Now, this is where the issue becomes a little more complicated, because, for example, if the foreign entity has a taxable presence in India in the form of a PE, then if you are making a payment of 100, are you going to withhold tax at the rate of 100? Or are you going to withhold tax at some lower amount? That is as far as the quantum is concerned. And then what is the rate that you're going to apply? Because if you look at it purely on the base case scenario, you are required to withhold at the maximum marginal rate applicable to the non-resident. So for example, if it's a non-resident company, then you are required to withhold 40% plus surcharge plus cess. And if the amount is not quantifiable, then you are required to withhold actually on the gross. So we are talking about withholding taxes at the rate of 43% odd. Now, that's obviously is not possible or feasible, and therefore there is a provision under the Income Tax Act which allows you to approach a tax authority officer to get a lower deduction of tax certificate. Now, this can be made either by the payer or the payee, and you can actually make that application, and basis the details provided by you, the tax officer makes an initial assessment and accordingly asks you to withhold tax at a particular rate. Now, there are some addition important points. So, for example, what happens when you are making payment to say different non-resident entities, and one which is fully taxable, second which is partially taxable, and third which is completely non-taxable. What would be the obligations? Now, this is where it's important that we need to understand how we are going to calculate it on the basis of the nature of income that we are making payment. So, for example, if the payment is in the nature of royalty or fees for technical services, you can withhold on the gross amount at the applicable rate, which can either be 10% or 15% or 20%, depending on whether the act is applicable or the treaty, and if it is the treaty, then what is the definition of those terms, and accordingly you do the withholding, right? The other aspect is if it is a composite payment, then what do? Then you have to, by compulsion, you should go to the tax officer, and the tax officer would be the only person who will give you a withholding tax certificate, which will allow you to withhold tax at a lower rate, and that would also help you as a payer not to be further responsible for any withholding related non-compliances. This is a very important point for the payers to keep in mind, because otherwise you run the risk of being held liable and responsible for not withholding taxes. The other issue which is very, very critical is when you are making a payment, whether that payment should be in the nature of royalty or fees for technical services, and therefore whether you are liable to withhold tax on a gross amount or not. Now, this again has been a debate which has been continuing for a long period of time. But fortunately for us, we have got now a reasonable amount of clarity with regard to treating a particular payment as software service payment or a non-taxable payment, especially taking into account the Supreme Court decision in the case of GE India Technology Center, where they had very categorically stated that most of the payments that we generally encounter may not be subject to tax in India as software payments because it is not in the nature of royalty. Now, the other issues that are important is the withholding tax is applicable even when you're making payments in kind. Now, again, just to give an example, in the case of Kanchenjunga Seafoods, the Supreme Court was entrusted with the responsibility of checking whether or not there was any withholding that was applicable in respect of certain fish that was handed over to the non-resident without taking into account the withholding implications. Now, after going through the particular set of facts, it was clarified by the Supreme Court that when you're getting the ship from so what happened was the Kanchenjunga Seafoods was an Indian company who had acquired a vessel from a non-resident, and they used that vessel to catch fish in the sea. And once the fish is brought back to the port, then they did a verification and what is edible and what is non-edible, and then once the edible fish were separated, then they actually gave away 80% of that to the to the vessel owner towards their hiring charges, right? And they claimed that look, I bought the fish from outside India. I bought the vessel also from outside India, and I paid the ship owner in the form of the product, and I didn't pay any money from India, therefore it is not taxable. However, the Supreme Court held that look, you have got the fish into India, the subsequent segregation of edible fish and non-edible fish happened in India. The what is to be given to the vessel owner was decided in India. So it was effectively a payment made from India, and therefore they held that the Indian payer was responsible for withholding. Now, again, we had already discussed about applicability of TDS on reimbursements. This again is a debatable point, and more often than not, the courts typically hold that since there is no income element there in the case of reimbursements, it should not be subject to tax. But it is not free from doubt, because what happens is when you're making a payment, say for example, when you make a payment in the nature of fees for technical services to your non-resident counterpart, are you supposed to withhold tax or not? Now, the claim from the taxpayer could be, look, I have actually spent X amount and I am charging X amount. I'm not charging any markup on the same, therefore it should not be subjected to tax because I'm not earning any income. Whereas the other way of looking at it would be, I am making a payment in the form of fees for technical services, and therefore it is my obligation to withhold tax because I am required to withhold tax as per the Indian law requirements, and unless and until that is done, I would be under violation. So this is again a debatable point, and which will have to be debated and analyzed very, very carefully before a decision is taken. The other part is TDS not applicable in imports. I think this is pretty standard. So if you're getting a product from outside India and you're making payment in respect of that product, when the transfer of title happens outside India, it is not subject to any tax in India, as held by the Supreme Court in the case of Ishikawa, Harima Heavy Industries. But I think it becomes a little more complicated, especially when the non-resident happens to have a PE, because whether or not this import is connected to the PE or not, it can become an issue, and therefore we'll have to be analyze that part carefully. The last one is in respect of applicability to self, which is primarily relevant for banks, because most of the banks typically operate in India in the form of a branch office. So what happens if the foreign headquarters or one of the regional offices charges the Indian branch of some interest? Are you supposed to withhold any tax or not? I think this is actually a case before the Calcutta High Court, where in the case of ABN AMRO, the High Court held that since you are making payment to yourself, there is no liability for you to withhold tax. Now, I think that there are some critical points with regard to availing the treaty rates. You have to come up with a tax residency certificate, and if the tax residency certificate are not covering all the required prescribed requirements, then you have to get a form 10 along with that. Only then this becomes a complete tax residency certificate, and therefore you would be in a position to avail the treaty benefit. Now, there have been debates, especially in relation to favorable tax jurisdictions like Mauritius, where the tax authorities have challenged the ability of an Indian a foreign taxpayer to claim benefit of the treaty. But more often than not, and this has been clarified by a number of judicial precedents, where the courts have generally taken a view in favor of the taxpayer. And also the CBDT had clarified time and again that, TRC should be regarded as the sufficient evidence of the non-residents tax residency status, and therefore if you have a TRC, there is no reason for you not to avail the benefit. Now, very quickly on the application of nil or lower tax certificate, this is how you can actually approach. You can approach either under 195(2) if you are the payer, or 197(2) if you are the payee. 195(3) is a very specific provision which typically governs branches of foreign entities. Again, more relevant in the case of a bank or an insurance company, where you could make that application. And generally, while the 195.2 does not provide any prescribed format, there is a specific format available for 197.2. So you need to make the details of your income, and then how do you characterize the payment, and what is the amount of tax that you expect it to be, within. And thereafter, the tax officer is required to review all of this, and if he's satisfied, then he's going to issue a certificate asking you to withhold the tax at the appropriate rate. Some of the aspects, like, for example, we were just discussing what would be the instance where if you are entitled to the treaty benefit, and at the same time, you are also required to withhold tax, as per the Income Tax Act. And Income Tax Act has a specific provision under 26AA, which says that, if the non-resident, if the payee does not have a PAN, then you can withhold tax at a higher rate. Now, the question that arises before us is, are you going to be governed under the rates prescribed under the DTA, or are you going to be governed under the rates prescribed under Income Tax Act? Now, to further complicate the matter, 206AA actually also has a notwithstanding clause, right? So therefore, it becomes even more critical. However, fortunately for us, we have got a Delhi High Court decision in the case of Air India, where the court had held that, look, the provisions of the Act are subservient to the provisions of the treaty. So if the treaty provides for a lower rate, then that will prevail upon whatever requirements that may be there under the Income Tax Act. And 206AA, even though it has a non-obstant clause, still it is not a charging provision. It is only a procedural provision, and therefore it cannot override. In fact, the court went to the extent of saying that even the charging provisions under the Income Tax Act, which is Section 4 and Section 5, they cannot override the provisions of the treaty. So therefore, I think, in most cases, the situation is pretty clear that, you do not have the ability to actually, withhold tax at a higher rate, even if the non-resident is not in compliance with some of the procedural aspects, so long as, you are withholding as per the rate provided under the double taxation avoidance agreement. The other issue was, like, for example, if I know that I am not required to withhold any tax, but still I go and make an application to the tax officer, whether the tax officer is required to give me a certificate on the basis of the provisions of the Income Tax Act, or whether the officer is in a position to actually interpret the the withholding provision as per his own justification to actually ask me to withhold tax at a much higher rate. Now, this was also clarified by the Karnataka High Court in case of Flipkart, where people from Walmart, when they were coming to India to provide certain support services to Flipkart, and they just wanted to be absolutely sure, and they made an application for a lower, in fact, nil withholding tax certificate to the tax officer. That tax officer was of the view that it is actually in the nature of fees for technical services, and therefore you are required to withhold tax on a gross basis at the applicable rate. The High Court, ignored that and held that you have to apply the provisions of the Income Tax Act. And since this is a position where, I am actually there was no requirement to withhold tax. And if I am going to make a payment, just because I made an application to the Income Tax Department, the Income Tax Department is not in a position to actually try and give a different color just because it is being asked to provide a certificate. I think, when services are utilized outside India, as you would recall, the provisions of the Income Tax Act are very clear in relation to, 917B, where it says that, if you are making any payment that is in the nature of fees for technical services, and if it is actually utilized outside India for income generated outside India, and the payment was made outside, even if from India to a person outside India, then it is not subject to tax. And this is a position that was withheld by the Delhi High Court. And subsequently, the SLP filed by the tax department was dismissed by the Supreme Court. So this has become like the rule of law. The other issue that was critical was in relation to TDS responsibility, whether it can, it can be fictionalized, and you could actually expect, just because one of my subsidiaries was making a payment in relation to a transaction that is undertaken outside India, where the situs of the transaction is outside India, just because I happen to provide a guarantee, whether I could be held liable for withholding any tax. The Bombay High Court was of the view that you cannot expect somebody who's not a payer or the payee to undertake any withholding obligations, especially when no payment was made from India. I think one of the other points is whether in the case of a non-resident to non-resident transactions, would you be withholding, would you be filing 15 CA-CB, which are basically the requirements that are required to be justified when you are making payment? Because if your non-resident is making a payment to a non-resident, this becomes obligatory, because otherwise the banks will not allow you to transfer the money. But what happens if it is a transaction between two non-residents where no money is being floated, routed through India? Even then, again, there are two views possible. But in our view, in a more conservative way, you should try to comply with the provisions, because there is no reason for not filing these forms, because these are the requirements which are arising from the provisions of the Act read with the rules, and therefore there is no reason for us not to withhold, not to submit these forms. Then this is again there is a requirement for now filing this form 10F in electronic form, which has become a problematic aspect, because especially if you do not have a PAN, because there is this electronic filing which is required. Now it's been extended till September 30th, 2023. One is not very sure what one will do if it is not extended, but we are hoping that this will get extended soon. These were the questions that these were the views that I wanted to share with you, and I'd be very happy to take any questions after the session is over. And I'll hand it back to Mr. Chopra. Thank you, sir.
Thank you very much, Mr. Patnaik. That was excellent and very useful.
Sure.
Thank you very much. Comprehensive again. And I think I wish we will try and see if we can circulate these, but let me see. My next topic is two extremely important and interesting topics of the moment. TDS provisions on benefit or perquisite in respect of business or profession, that is section 194R, and TDS on payment of certain amounts in cash, 194N. We have Mr. Salil Kapoor, again a very reputed counsel and a highly respected counsel. Salil is regularly arguing in the courts in Delhi, in other cities, in the Supreme Court, in the tribunal, and he has over 40 years of experience. Somehow I did not know that it is more than 40 years. He is so affectionate in the way he deals with me that I thought I'm fairly older to him. Both advisory and litigation, domestic, international, corporate, transfer pricing, and then related laws like black money, benami, and then other laws also, including property tax and so on. He's into transaction advisory, tax planning, and does, apart from a very senior level of litigation, a high level of advisory work on tax implications of transactions, M&As, and so on. Section 194R, many people feel is going to be cause of serious concern and is to an extent perhaps going to cause certain difficulties for people which may not have been the original intention. And there are going to be some that are difficult to comply and which have serious consequences. And just to take an example, and he will tell us to what and when, and is it liable or not, and what is his view as a senior expert. But there is a businessman, in the course of his business, his debt has gone bad from a customer. He writes off that debt. So 100 rupees of debt written off. Now, if it is to be said that he has given a benefit or perquisite to that customer from whom that debt was due, then he is liable to deduct tax at source. And this tax at source, the customer who is not paying him his money, which is why he's writing it off, no prudent businessman will write off otherwise. Not only has he lost money, now he has to pay TDS, and that TDS is not on his income. That TDS is an amount that he deducts on a loss, and an amount which is deemed to be perhaps, if so, a benefit or perquisite in the hands of the recipient. And that recipient, the reason he's got a bad debt is because he may be having losses. He may not be having taxable income. If he doesn't have taxable income, then is there really need for that TDS? But as far as the person writing off that debt is concerned, suffering that loss, he has to suffer a further loss of tax at source if he is liable to deposit the same. This is one example. There are several examples. Let me take one more example, please. You gave a sum of money A to B in the course of business, and for good reason, you do not charge interest. It may even be that there are other mutual benefits over time in the course of bona fide business, for business exigencies. And so far, all our life, it has been settled law that no notional interest is taxable. If you give a loan from your own money, there is no deemed income taxable on it. There is no such view or law which is there. Now, he gives an amount free of interest. Is it something which results in benefit or perquisite in the hands of the receiver, borrower? A third case, and I will not go to fourth because I want to listen to the answers, and more than Salilji to go through the general provisions, I will appreciate with your seniority and knowledge if you would go to the legal nuances of these provisions and the applicability to such situations. Of course, you may take it as you deem best in the course of your presentation in a broad manner also. But the third situation is remission or cessation of liability. So again, there is a sick company. That sick company has an amount due from company Y. Company Y settles 100 for 50. Now you settle 100 for 50. Is there a benefit or perquisite given to that sick company? Now, if you are a bank or institution, it is not counted under certain, that sort of situation has been thought of and covered. But what about private party to private party? Is it not something which has happened? Is there not a bona fide business settlement, and is the intent just to settle and get my money back, or to give, provide for a benefit or perquisite by settling 100 for 50? Now, what happens in these cases? What about IBC cases? Again, there is an extremely difficult situation. And if you don't have an NCLT judgment as part of the scheme in IBC, then what happens? Which covers this settlement. So I'm laying down the kind of situation because these are live problems today. This is a comparatively new provision, and these provisions need discussion from such senior and very distinguished experts. So I will leave it there for a moment. What is to be done in such cases? Is there a liability or not? And then just to complete the picture, there is a board circular and circulars and what they say about such situations. And then there is another situation of rebate or discount that they say is all right. Rebate or discount is not benefit or perquisite. But whether I gave a rebate of 50 rupees or whether I wrote off 100 as a bad debt, is 100 bad debt written off provided as benefit or perquisite? There is no voluntary provided done by me, the person who wrote off the amount receivable. Please take over from there, Salilji, and kindly welcome all of you. Mr. Salil Kapoor, please. Thank you.
Good afternoon, friends, and thank you, Anil Bhai. You have always been very kind, and I thank the PhD chambers also for giving us, the speakers, this opportunity to interact with you. And I was looking at the number. The Anil Chopra Bhai's popularity is so much that there were more than 500 participants. Now the number is around 400, but the good part is that we are able to assist so many people. And for that, the preparation by the speakers is excellent. And the role of Anilji to have all these complex TDS issues collected and then trying to assist the industry on these subjects. Anil, the basic principle of TDS is that it is a tax on the income of other person. And by provision of Act, I have been saddled with the liability to deduct and pay. And it is a government's job. It's not my liability. I have a very vicarious liability. It is the liability of the person who is receiving the money. But the provisions of TDS are such that the payer has to deduct and pay. And if there is any technical default or genuine or non-genuine default, the serious consequences are there. We have 201, which says that I will be treated as a cessation in default. It can be collected from me. Then there is an interest under section 201(1)(a). Then there is a penalty of 271(c). Then there is a disallowance of section 40(ai). Then in some of the extreme cases, there is a prosecution where the tax is deducted and not paid. So there are serious consequences in respect of TDS. Although the provisions have been little relaxed, that were under 201 and section 40, where the other person has made the payment, and I get a form 26 AS from that person and file it, at least I am not required to pay them. But the other consequences of penalty, interest, and the prosecution are still there. Now coming to the topic which the PhD Chambers has given me, is with respect to the issues relating to section 194R and 194N. These are comparatively new sections, and particularly 194R is introduced by Finance Act 2022 with effect from 1st July 2022. The basic ingredients of this provision is that there must be some benefit of perquisite, whether convertible into money or not. It must be arising out of business or exercise of profession. It is applicable to the benefit provided to the residents. Then the value of benefit provided must exceed 20,000 aggregate in a financial year. This 20,000 limit is too low, but they have given this limit of 20,000. Then the TDS at the rate of 10% is required to be deducted. And where the benefit is in the nature of cash and kind, and cash component is not sufficient to meet the TDS liability, then the person providing the benefit shall ensure the tax required to be deducted has been paid by the recipient of the benefit before releasing such benefit or perquisite. I'll be elaborating this provision a little later, but these are the basic ingredients of section 194R, and exemption is given to smaller assessees. The provision does not apply to individual or HUF providing benefit or perquisite whose total sales, gross receipts or turnover is below 1 crore in the case of business and 50 lakh in the case of profession in the financial year preceding the financial year which the benefits are provided. This is a chart where we try to show that on the left where it is written yes, the benefit and perquisite is if all of these conditions are fulfilled, that it's a monetary or non-monetary or partly cash exceeding the limit, eligible payer and eligible pay, benefit and perquisite arise from the business, then it is yes. If any of these conditions are not fulfilled or are not met, then I don't need to do the TDS, which is on the right flag. The idea is to show that there are certain conditions. If we come under the conditions, then the TDS has to be deducted. Now, what is the purpose of this amendment? This came up in the Finance Bill 2022, and the idea is that when during the course of business or profession, the recipient receives some benefit which is otherwise taxable under section 28(4). But in most of the cases, it is seen that the recipient do not report the receipt of benefit in their return of income, leading to furnishing of inaccurate particulars of income. Therefore, in order to plug this loophole, section 194R was introduced. So this is important because I'll be dealing with this later on, that this is to plug the loophole that the benefit which is otherwise income is not being reported, although the section 28 clause 4 is already in existence in the act. But this part was being missed as many of the recipients of these benefits were not declaring it as income in their hand. So in order to plug this loophole, the government has introduced 194R. Now, the subsection 2 and subsection 3 of 194R, pursuant to the enabling powers of subsection 2 of section 194R, CBDT can issue guidelines to remove the difficulties arising in giving effect to the provisions. Subsection 3 mandates that every such guideline shall be placed before each House of Parliament and shall be binding on the income tax authorities and on the person providing any such benefit. Now, under subsection 2, in order to remove the difficulties arising from these provisions, the CBDT has come up with 2 circulars. The circulars are circular number 12 of 2022, dated 16/6/22, then circular number 18, dated 13/9/2022. I'll be dealing with these circulars now independently. The guidelines to clear the airline on numerous vexed issues, including taxability in the hands of the recipient's hand, the nature of the asset is given, the TDS compliance where cash component falls short, valuation of free medicine samples, sale discount, other incentive. These are just few examples, out-of-pocket expenses. Now, the important part, which is that the payer deductor does not need to verify the taxability of the amount in the hands of the payee under section 28(4). This is what I was mentioning earlier, where they say that the purpose of bringing this amendment is that the benefit or the perquisite which is accruing to the recipient is taxable under section 28(4), and that tax is not being reported. So in order to plug this loophole, it is brought that the TDS of 194R will be deductible. But when you come to the provision and the taxability of the amount under section 28(4) is not to be looked at. The important is that while the TDS provision is applicable to any benefit or perquisite to the other person, the taxability of that is not to be seen. The CBDT places reliance on the Honorable Supreme Court's ruling in the case of Pilcom, that stating that where a specific TDS rate is provided, there is no requirement to assess the payee's tax liability. So the point of discussion, interestingly, the payer is not required to look into the aspect of taxability in the hands of the recipient. It means 194R is applicable even if the recipient is receiving the amount which is not in the nature of income. And the language used in the provision of 194R is different from most of the other provisions of TDS, where the reference of income is given. But interestingly, the word income is not there in 194R. So that brings us to the same point that even if it is not income in the hands of the recipient, the TDS requirement is still there. The payer has to make ensure that the TDS is deducted and paid. Next one. The nature of asset given as benefit and perquisite is not relevant, and even a capital asset given as benefit or perquisite are covered within the scope of 194R. This is what I was mentioning, that what is being given, whether it's a capital in the hands of the recipient or an income, is immaterial. The CBDT categorically uses the phrase of whatever nature on benefit and perquisite for fastening the TDS liability on the payer. The CBDT provides relaxation on sales discount, as was being mentioned by Anilji. Cash discount and rebates allowed to customer by excluding them from the purview of 194R, as their inclusion would put the seller into difficulties. CBDT does state that these are benefits perquisite though related to sale purchase. However, section 194 shall apply to seller giving incentives other than the discount or rebate, which are in cash or in kind, such as TV, computers, gold coin, mobile phone, sponsors trip, free ticket, medicine samples to medical practitioners. It is noteworthy that the list provided by the CBDT is not exhaustive but only illustrative. CBDT clarifies that in case where a company provides free medical samples to a doctor employed by the hospital, firstly, the company has to deduct TDS from the hospital. Secondly, the hospital as an employer may treat such sample as taxable perquisite for employees and deduct tax under section 192. For doctors working as consultant with a hospital and receiving free sample, TDS would ideally apply on hospital first, then in turn would require to deduct tax under 194 with regard to consultant doctors. CBDT also clarifies that as an alternative, the original benefit or the perquisite provider may directly deduct tax under 194R with regard to the consultant doctor as a recipient. Now the question next comes with the valuation of the benefit. The general rule is that the valuation of benefit or perquisite shall be based on the fair market value with following exceptions. Provider purchased it before providing it, then the purchase price. Provider manufacture it, then the price charged to the customer. So the same item, if it is given by the trader as a perquisite or a benefit to the other person, then his purchase price is to be taken as the value. But if the same benefit is given by the manufacturer, then in the case of the manufacturer, then the price charged to the customer is to be taken as the value. So the same benefit being given to person A by X will be different, and by same benefit given by Y, because the Y is the manufacturer, so the amount will be different. However, it is noted that such value will be exclusive of GST. So the discussion point, a person receiving the same benefit from a different people, that is from a trader or as a manufacturer, will lead to different valuations. because in one case it is the purchase price and in the other case it is the price charged to the customers. In the case of social media influencers, benefit of perquisite being a product given to the social media influencer, which is returned to the provider after using it for the purpose of services provided by the influencer, shall not be subject to TDS. However, if the products are retained by the influencer, then it shall be subject to TDS. As in other case also, the amount of reimbursement was discussed. So the applicability of 194R would depend on the name on which the invoice for out-of-pocket expenses is made. If now they have clarified that if the invoice is made in the name of the company, I'm giving an example of a counsel who is providing service to a company, and for that during the providing of services he has to travel to another city, and the traveling charges is taken from the client as a reimbursement. So according to their circular, if the invoice is in the name of the company, then no TDS is required. But if it is in the name of the counsel and he takes it as a reimbursement, then the TDS is required to be made. If the invoice is not in the name of the client and the payment is made by the client directly or is reimbursed the consultant, then it is the benefit given to the consultant on which the section 194R will apply. Now the point of discussion, how does the changing the name of the invoice create a situation where in one instance it's a benefit and in the other instance it's not a benefit? Same transaction, same thing, but in one situation according to the circular is a benefit and in the other situation it's not a benefit. Whether accommodation, travel to consultant are benefit at all. Next question will come, which was coming to our mind, whether it's a benefit to the counsel. If he is traveling to another city to conduct a matter or to appear in a court on behalf of this client, is it and he charges the reimbursement is given for his travel and accommodation? Is it a benefit at all? Will it be taxable under section 28(4)? It's not a benefit, but according to this circular and the section, the payer does not require to look whether it's an income in the hands of the recipient or not. The TDS has to be made. Then the situation, question number 8 was the expenditure incurred on dealers conference would not be subject to TDS if held with the prime object to educate the dealers or customers. Exception to this rule is that conference must not be in the nature of incentive benefit to select dealers customers who have achieved a particular target. This will come under the earlier provision which we were reading, that these are the benefits in the case of travel, conference, benefits connected with sales or particular targets when they are achieved. In that case, it will be TDS. But where the conference is to educate the dealers or the customers, then it is not. The TDS shall apply if the expenditure is attributable to leisure trip or leisure component, even if it is incidental to dealers' business conferences. Incurred for family members, if the family members are also accompanying the person attending the conference, the TDS is applicable. On particulars of dealer business conferences for days which are to be counted prior to stay or overstay beyond the date of such conferences. So if the conference is for 2 days, but the person stays for 4 days or 2 days extra after the conference, the 2 days part will be subject to TDS because that's a benefit. However, in the circular, they have clarified that if the 1 day before and 1 day after will not be treated as leisure travel. Now, interestingly, as per the first proviso of 194R, it is the responsibility of the recipient of the benefit to pay. Where a person is providing benefit in kind and is required to ensure that the tax required to be deducted has been paid by the recipient where cash is not sufficient to meet TDS, the deductor may rely on a declaration along with the copy of advance tax payment challan provided by the recipient confirming that tax on the benefit of perquisite has been deposited. Now, interestingly, if the benefit being given is in kind or it is in cash and kind and cash is not enough to pay the tax reduction at source by the payer, then before the benefit is released to the other person has to pay tax on that. And then the same is to be conveyed to the person who is giving the benefit, and only then the benefit can be released. Now, interestingly, they themselves put it in the circular that the other person who is required to pay TDS here is to pay the advance tax. So, if he pays the advance tax and then the receipt is given to the payer, only then he can release the benefit. The situation can create so many complications. If it's a loss company who is receiving, where is the question of paying advance tax? There are multiple benefits on multiple dates. Where is the question of paying advance tax on all those dates and then give the challan to the payer? As rightly said by other speakers also, and Anilji also, that all these provisions are going to create a lot of litigation in the coming years if these things are not further clarified by the CBDT. In such a case, the same needs to be reported in TDS return along with challan number for which Form 26(2) has included provision for reporting such transactions. Now, another situation. Alternatively, the benefit provider may deduct the tax and deposit with the government, where TDS should be after taking into account the fact that TDS is also a benefit under Section 194R. This needs to be reflected in 26Q as tax deducted on benefit. Now, this is an indication of grossing up. The example is a person is giving one gift on achieving the company is giving gift to their dealers on achieving certain threshold of sales. Say one car is being given worth 20 lakh. So the 10% 20 lakh is 2 lakh is also paid by the company who is giving the car. So this 20 lakh is also benefit because the benefit of 20 lakh will be given to the other person. Then there might be a case which needs grossing up will also arise in this situation. This is indicated in their circular, which I am referring. There can be a situation where the recipient is incurred losses, whether the advance tax still has to be paid by the recipient, because even if the benefit is included in his income, there can be still loss and he is not required to pay any advance tax. But in this situation, he will have to pay the advance tax so that the benefit can be released. There can be a situation where the advance tax has been paid, but the benefit is not released. Now, there can be a situation where he has paid the tax or advance tax, but because of some reason, some dispute or some complication, the benefit is not released by the payer. So all these situations will come because of the practical difficulties. Then the calculation value of aggregate value of the benefit of perquisite triggering TDS shall be counted from 1st April 2022. However, the TDS will apply on any benefit of perquisite provided on or after 1st July 2022. Now, this is what Anilji was also mentioning, but this is with reference to banks or the loan giving companies. One-time loan settlement with borrowers, waiver of a loan granting on reaching of settlement with the borrowers, certain institutions, persons enumerated in the circular would not be subject to TDS under Section 194R. Then reimbursement of out-of-pocket expenses, further clarification is given. Any expenditure, now this is the second circular I am talking, which is number 18 of 2022. So any expenditure which is liability of a person carrying out business or profession service provider, if met by any other person, that is the recipient, is in effect benefit of service provider, where the bill of such expense is in the name of service provider, incurred as a pure agent of the service recipient, and the amount incurred by such pure agent as defined in the GST valuation rules reimbursed by the recipient would not be treated as a benefit perquisite for the purpose of Section 194R. So this is the same situation where I was referring earlier about the reimbursement, but here now they have clarified that if the person who is the service provider and during the provision of that services he incurs certain expenses and he is a pure agent as per the definition of pure agent given in the GST valuation rules, then in that case, the TDS is not required to be deducted because the benefit of the GST will be claimed by the recipient of the service, and it is reimbursed by the recipient, would not be treated as a benefit or purposes for the purpose of section 194R. So in certain situations, the same action or the same service provider is getting a benefit, and in other situation he is not getting a benefit. Next, please. It is if the out-of-pocket expenses form part of consideration on which the under relevant section 194J or 194C, as my friend was Neeraj was mentioning at the time of his presentation. If the TDS is also covered by other sections and it is dirty, then there will be no requirement of further liability of 194R. Now, particularly the conferences about the business dealers conferences, clarifications are further given that the TDS will not apply if there's a requirement that there must be all the dealers must be invited in the conference. These are the conditions laid down. If the dealers arrive one day before and one day after, the expenditure on participants on account of overstay would be a benefit. Prior days of conference would be a benefit purpose. However, a day immediately prior and immediately after the conference would not be considered overstay. As I was mentioning earlier, so they have given a benefit of one day before and one day after, it will not be considered as a purpose. However, to identify the benefit against individual dealers in a group activity, if the benefit is provided in group activity whereby it is difficult to match the benefit to each participant, the provider of such benefit purpose at his option may not claim such expense as deductible expenditure in his computation of total income. Now, this is an interesting situation. They want that the genuine business expense may not be claimed only because it's a group activity and you are unable to identify the benefit given to each participant. So instead of saying that no TDS will be required in such a situation, this is a benefit given that you don't claim a genuine expense or the business expense. That's exactly what I wanted to say earlier, that all these provisions and the circular are likely to open up further litigation instead of the simplification or the ease of business as was being referred. These circulars may create further complications, and the government should have come that in such a case where the group activity and for the introduction of new item or education of the dealers to be familiarized with the new products, it should not be covered under 194R. Instead of that, they say that you are unable to identify. So the benefit given may not be claimed as expense at all, which is a genuine business expense. Upon making such a choice, then he would not be required to deduct TDS under section 194R, and that would not be considered an assessment default. So the alternative suggests that a business will have to forego their legitimate business needs, business expense. Question number 5. The A has deducted tax on provision of capital and perquisite, and B has shown the same in the ITR. The actual cost of the capital asset for the purpose of section 32, where the amount of benefit included in the B in the ITR thus would be eligible for claim of depreciation, as the same is subject to fulfillment of other conditions specified for claiming the depreciation. Now, the point of discussion is here what the mayor is saying is that if the benefit in kind is used for the purpose of business which is already declared as income, the benefit of depreciation can be claimed. But whether the TDS paid by the benefit provider will be included in the actual cost. So the tax paid, if it is not paid by me, it is paid by the deductor or the benefit provider. Will it be included for the purpose of section 32 depreciation? Then this is an exemption given to a basis and High Commission of 194R. Now, with reference to question number 7, the tax under section 194R is not required to be deducted on issuance of bonus right shares issued by a company in which the public are substantially interested, where bonus right shares are issued at all the shareholders of such a company. Now, what about the private companies and closely held companies? So it's a discussion point. There is no clarification regarding bonus shares, right shares issued by the privately or closely held companies. Next, please. the CBDT has had, has given these two circulars. However, they have come out that the chairman has made a statement that we are further open to suggestions in this regard in respect of 194R circular, and we want to clarify the situation if further required. So I hope genuinely, and I also hope the business organizations will approach the CBDT to further clarify the situations, as one of the or two, three situations identified by Anilji also mentioned in the beginning. There are going to be some of the points of concern. This is what Anil bhai, you were telling. The write-off of trade receivable, whether a benefit arising out of business of exercise, it will be further increase the losses. Exactly. If I am unable to collect from somebody to whom I have sold, which are the purchases in his hand, and I am unable to collect and I write off. And when I do a write-off, it's a whether it's a benefit to the other is not to be seen under section 28, subsection 4. Although it's whether it's a benefit or not, it has to be tested in the courts. But the person who has incurred losses by not getting his money, he will further have to pay TDS on that, which will further be a burden and loss to the payer, because it will be treated as a benefit. And then, as I mentioned earlier, the bonus shares by the private limited companies and the closely held companies is yet to be clarified. The corporate guarantee provided by the parent company, which is very common in the present business scenes, that the parent company is providing corporate guarantee so that the subsidiary is able to use the money from the bank for loans. But what about the benefit nature? It's a benefit that the TDS has to be deducted by the parent company. Now, as rightly said, the benefits, whether the benefit is there or not, the TDS has to be deducted, which is a provision in other provisions of TDS. This kind of situation may not be there, that the person who is receiving the benefit, he has to pay the advance tax first, whether he is in a position to pay or not. Only then he provides the proof that the tax is paid by me, only then the benefit will be released. Now there going to be, the already litigation has started. This Parkan company is a broker for tea auctions who are in receipt of tea samples drawn specifically for tea tasting and valuation. Representation was made before CBDT, and CBDT wide order dated 22/12/22 held that the petitioners are liable to pay TDS. Then the company has approached Calcutta High Court. Petitioners have challenged the CBDT order of 2012/22, contending that it is not that they are not the real beneficiary and the owner of the goods, and they may barely distribute sample to tea to the buyers on whose behalf the sellers, and as such those free samples cannot be treated as perquisite in the hands of the petitioner. But these are the practical difficulties. The samples are given to the brokers by the gardens, and those samples are further distributed among the customers and the traders or the dealers, distributors. So they are not keeping the samples to themselves, but samples are necessary because the tea is such an item that it has to be for the tasting and valuation purpose. In the auction, the brokers will give the auction or the bids only once they have samples, they have tested it, and the evaluations are made because through the tea testers. So all these practical difficulties are going to come, and kindly see the second part. The Parcon has approached the CBDT to get the clarification. So the clarification was against them. Well, it's a clarification. It can be against also, but these are the situations where the requirements are, or the hardship has to be mitigated. That's the purpose of the circulars of two circulars. But further circular, they say that we are open to further clarifications, which should be used. But here is a case where it was rejected that the TDS has to be deducted, and it is in litigation now in before the Calcutta High Court. This is the another section which was given to me to talk about, because this is also a new provision on the cash withdrawals. So the cash withdrawals from the bank, they have introduced TDS on the cash withdrawals. The limits are 20 lakh. If no ITR is paid, is filed for the last 3 previous years, and 1 crore if the income tax return is filed in one of the 3 previous years, TDS is to be deducted by the bank, private, public, and cooperative or post offices. The TDS is 2% on cash withdrawals in excess to 1 crore. Then the TDS is 2% cash withdrawals of more than 20 lakh and 5% of withdrawals of more than exceeding 1 crore if the return for any of the 3 years is not filed. These are all provisions which are created to check the cash transactions. The last is the TDS on cash withdrawal in 194N will not apply to withdrawals made by the certain person enumerated. Some exemptions are given. Next page, please. The section was introduced with the objective to reduce cash transactions and move towards less cash money economy. Exemption has been carved out of payment made to certain recipients, such as government, banking company, cooperative society, keeping in mind that such person handles substantial amount of cash as part of their business operation. Interestingly, it is a tax on the money which is already in my bank. So once I add, it's a tax paid money. So once I withdraw cash, it's going to be subject to TDS. But this TDS is going to be adjusted against my income and advance tax. So but it will be subject to TDS. Next, please. I have been able to give this small presentation with the help of my colleagues in my office, and especially I thank Mr. Vibhu, the advocate, who has assisted me in preparing this presentation. Thank you, Anil Bhai. Over to you, to the chairman, sir.
Thank you, sir. Thank you, sir. Thank you very much. It was very interesting. And I wish I had more time to listen to everybody. And I now have 2 more speakers, apart from the vote of thanks, and we have come to the end of our day, 6 p.m. I'll just request both the speakers that, supposing you had 25 minutes, I'll be very grateful if you could cut it to 20 minutes, considering we are already at 6 p.m. The next speaker is Rohit Jain, and he will be handling TDS on rent of assets and transfer of immovable property. Rohit Jain is a partner of Vaish Associates. He's a CA cum lawyer. He's an extremely distinguished tax expert, both in advisory as well as litigation in various forums. Advisory is also across the board, and he does appear in various courts and tribunals and quasi-judicial authorities. Numerous matters of precedent nature and of significant nature have been argued by him for preeminent clients. He has also been recognized in Asia Law Profile as a recommended lawyer. Mr. Rohit Jain, please.
Thank you, sir. Thank you, Anil sir. Thank you, PhD. Good evening, everyone, for giving me this opportunity to be part of this webinar on withholding tax provisions. So my, the brief is to deal with two or three sections, which basically are tax withholding provisions relating to the real estate transactions. So how I will structure my presentation is that since all of us over here are professionals, so broadly the section everyone is aware of. So I'll be very quickly referring to the section, and then dealing with some of the important issues which you may come across on a day-to-day basis. So to start with, I think the first yeah. So the first I'll be dealing with TDS on rent. So first I will be dealing with TDS on rent, which is basically section 194I. Now, just one next slide. Just 1 second. The next slide. So 194I, what I have done is I've reproduced the broad features of section 194I. What I'll we referring to and seeking to emphasize in some of the words which are, put in bold over here, which basically is that this section 194I talks of, deduction of tax at source or tax withholding on income paid and on any amount paid to a resident by way of which is an income of the recipient, and it is by way of rent. Now there are two tax withholding, rates. One is 2% for use of plant and machinery, and then 10% is for use of any land and building. There is a specific definition of rent, which will come to on the next slide. Now this section is applicable to, even to individuals and HUF who are subjected to tax audit, and the fundamental threshold of applicability is 2,40,000 in a year. So the payment should be 2,40,000 in a year. Now rent is defined. If we see the section definition of rent, that is very widely defined. So it is defined to mean any payment by whatever name called under lease, sublease, etc., or any agreement or arrangement of whatever nature for the use of. Now these words are very important, for the use of land, building, etc. So unless the payment is made for the use of either land, building, etc., it will not qualify as rent for the purpose of section 194I, and therefore the TDS provisions would not be applicable. Now, let us take few examples, and before that, let me refer to some of the clarifications which have been issued in the context of section 194I. So, for example, first clarification is with regard to the refundable and non-refundable deposit. Now, as we all know, in so far as refundable deposit is concerned, that is not subject to TDS under 194I, whereas a non-refundable deposit, which will get adjusted in against the rents, which will be payable in future. So on that, the withholding tax provisions would be applicable. Now, so for example, now you take a premises on rent. That premises is further given on rent for the purpose of hoarding. Now, the issue which normally arises is whether section 194C would apply or 194I would apply. Now, the substance of the matter is that the premises is taken on rent. Now, you may put a hoarding or you may put anything else over there. The fact is the substance of the transaction is the rent, and therefore the 190, the clarification is it will be there will be a section 194I deduction would be applicable. Then hotel stays, again there is a clarification which has been issued that in case the hotels there is an agreement for availability of hotel on a regular basis, the rooms in the hotel on a regular basis, then in that situation the TDS provisions would apply, otherwise it would not apply. These are some of the important issues which I'll deal with. Now first is common area maintenance expenses. Now, as you all know, when we live in societies, or for example in case of business organization, in this case of Connaught Plaza, the facts were the Connaught Plaza was running McDonald's restaurants. So it had taken space on a mall. And for the mall, while rentals were subjected to 194I, apart from rental, the company was also making payment of common area maintenance charges. So common area maintenance charges is basically for use of various facilities which come along with when you take the premises on rent. Now the issue was, now the department said that since common area maintenance charges also includes the usage of the common area apart from various services in the form of lifts, cleanliness, hygiene, etc. So they said that this will be subjected to 194I, whereas the taxpayer was deducting tax at source under section 194C. Now in that context, the controversy went to the Delhi Tribunal. And the Delhi Tribunal held that since the common area maintenance charges is not simpliciter for the use of the premises or the common area, but it is for bundle of services apart from usage of common area. Therefore, it is not simpliciter use of land or use of premises, and therefore it will not be subjected to TDS under section 194I. Similar issue would come up in the case of residential premises, where we apart from we also pay common area maintenance charges to our the service provider who may be providing the service. So usually a question arises whether those CAM should be subjected to TDS under 194I or even under 194C. In many societies, the CAM charges are actually in the nature of reimbursement, because these are non-profit organizations And in that situation, one can possibly take a view that since the CAM is in the nature of a reimbursement being paid on a cost to cost basis, therefore, even 194C would not apply, but that's a separate controversy altogether. But insofar as 194I is concerned, one can reasonably take a view that 194I is not applicable in case of CAM, whether it is for a commercial establishment or it is in a residential premises, because this is not for usage of the premises or a land, but it is for bundle of services which is made available by the service provider. Now, the second interesting issue which came up was in the context of landing and parking charges, which are paid to the airport authorities. Now, what happens is, when the airport in case of airlines, this controversies was there. Now, what happens is when the aircraft lands at the airport, for the purpose of landing and for the purpose of parking of that aircraft, certain landing and parking charges are required to be paid to airport authorities. Now, the issue was whether on those landing and parking charges, they will be subjected to TDS under section 194I or not. Not, sir. Not to just to explain how controversial this issue was. There were conflicting views which were taken, conflicting judgments of the Delhi High Court and the Madras High Court. So while the Delhi High Court took a view that landing and parking charges constitutes rent under section 194I, and therefore it should be subjected to TDS under section 194I, whereas the Madras High Court took a contrary view and said that this landing and parking charges are not, cannot be subjected to 194I. The reasoning assigned by Delhi High Court was that the landing, because when the aircraft, when it lands, it touches the, the strip, the land strip. So therefore, ultimately, the payment which is being made is for, the usage of the land. And therefore, the Delhi High Court said that it is constitute rent, and 194I would apply, because the definition of rent in section 194I is very wide to include all kinds of, agreements. The Madras High Court, however, said that it will be a too simplistic a view to be taken, that simply it is for use of the land when these aircraft lands. The Supreme Court considered both the judgments and analyzed it. What is the most important principle which is emerging from the Supreme Court judgment is they have emphasized on the word use of land. As I said in section 194I, definition of rent means payment should be for usage of the land. Unless the payment is for usage of the land, it will not get covered under section 194I. Here, the Supreme Court said that the landing and parking charges cannot be simplistically be said to be usage of the land. It is, for complicated services which are being provided by airport authority, and they refer to the fact that they, these landing and parking charges are paid for air traffic services, ground safety services, aeronautical, communication facilities, installation, maintenance, and they said there are a host of services, and there are complex, protocols which are, applicable in case of an aircraft when it lands at the airport. So therefore, it said that you cannot simplistically say that it is simply for usage of the land, and therefore 194I would not apply. Now, this principle, can be expanded to various kinds of situations. Ultimately, what we have to see when we are making the payment, whether it is in sum and substance for usage of land, premises, plant, machinery, etc., or the underlying intent is to use bundle of services, and usage of plant, building, machinery, etc., is only incidental. If it is incidental, 194I would not apply. But if the predominant intent is to use the land, building, etc., all those assets which are given in the definition of rent, then it will be covered by 194I. Usage of land, if predominant, 194I. Usage of land and assets, etc., if that is not predominant but only incidental, then 194I would not apply. That, according to me, is the ratio decidendi or the principle, which emerges from this decision. Now, another interesting controversy was in the context of passenger service fee. Again, this issue is relevant in the context of the airport, the airlines, but these are payments which are made by every user. So passenger service fee is basically when you buy a ticket, you will find that there are certain charges which are levied, which are called PSF charges, which is called passenger services fee. Now this PSF has two components. One component is basically for the use of the security, that payment. So if supposedly 250 rupees are charged as PSF charges for every ticket which you buy. Now say for example 100 rupees is towards security and 150 rupees is for various facilities which you avail of when you go to the airport, for boarding your flight or coming back from anywhere. Now that 100 rupees goes to the security agencies, which is basically operated by the sovereign, and 150 rupees goes to the airport. Now the controversy was whether PSF will be subjected to TDS, and if at all, if it will be subjected to TDS, whether it will be subjected to TDS under section 194I, or it may be subjected to TDS and maybe under section 194C or any other section. So various courts, including the Delhi bench of tribunal in the case of Interglobe Aviation, in the case of Jet Airways, the Bombay High Court, held that PSF charges is again not for usage of the land per se, but it is for various bundled services, and therefore it will not qualify as rent. Interestingly, the CBDT has accepted this, the judgment of Bombay High Court in the case of Jet Airways and issued a circular saying that PSF will not be subjected to TDS under 194I. But surprisingly, the CBDT circular stops at that and does not specify under whether or not the PSF charges will be subjected to the TDS, and if at all, whether it will be subjected to TDS under any other section. But the industry has been, what I understand is industry has been following various, various views. Most of the industry, the airlines have been deducting TDS under 194C. And even though one can, reasonably argue that the component of security, which is a payment to a sovereign, is not taxable in terms of section 195, 196, and therefore it cannot be subjected to TDS, but that's a separate controversy. But the sum and substance of this entire issue is that, it is not subjected to TDS under section 194I. Now, moving on, another, interesting issue is with regard to transmission and wheeling charges. Now, in all industries, when we have, captive power plants, now captive power plants may have to, my captive power plant may be located at place A, whereas my, factory may be located at place B. Now I will have to transport my electricity from place A to place B. I may have my own transmission channel wherein, I may, set up the entire transmission facility on myself. Or at times what happens is I use the transmission facilities of the state electricity board or any other service provider, for which I pay transmission and wheeling charges. These are called transmission and wheeling charges. Now the controversy is when I use the transmission facilities of any service provider or the state electricity board, whether it is rent for use of those facilities or your machinery, or it is not rent for use of those machinery, and therefore 194I would not apply. There are the predominant view is it is not, because again the point is what is the predominant nature. The predominant, the purpose of paying wheeling and transmission charges is merely transportation of electricity. I do not pay wheeling and transmission charges for the use of the equipments which are used by the service provider or the state electricity board for transmitting the electricity. So therefore, the underlying intent is only to transport my electricity, not to use those that usage is by the service provider himself. So the predominant view is that this transmission and wheeling charges will not be subjected to TDS under section 194C. Again, 194C, 194I. 194C, again, that controversy is there, whether that 194C would apply or not. But insofar as 194I is concerned, which, the revenue was invoking in most of the cases, the courts have held, and in fact, the SLP has also been dismissed, wherein it has been held that, it is not subjected to TDS under section 194I. Now, vehicles, as we all know, vehicles, again, it depends. If the vehicle come along with the chauffeur, the dominion and control of the vehicle lies with the chauffeur. And I, use the vehicle only for the purpose of transportation. In that situation, the TDS The better provision will be a 194C provision, that because that is more of a contract payment. But where I take the, the vehicle on lease, or where the vehicle is provided to me and it is in my dominion and control, and the charges which I pay is for usage of the vehicle, in that situation, it will be in the nature of rent of the vehicle, and therefore it may be subjected to TDS under section 194I. Again, another controversy is in the context of year-end provision. This again is a very highly controversial issue still to be resolved. As we all know, because most of the TDS provision says that the TDS has to be withheld at the time of credit or payment, whichever is earlier. And there is usually an explanation appended to almost all the sections, which says that when we say credit to the account of the payee, that means credit to any account, whether it be a suspense account or any account by whatever name called. So most of the companies, what they do is at the year end make provision for various expenses where the actual expenses may not be known. So for example, I may make a provision for telephone expenses, I may make provision for traveling expenses, where the bills are still to be received, because I follow a mercantile system of accounting. Now the controversy is whether all those year-end provisions are subjected to TDS. Again, if the pay is identified, then probably one will have to deduct TDS. Again, there will be practical issues, of course, as to how do I file a TDS return when the payee is not known. But so long as the payee is known and I make a provision, probably the conservative and a better view would be to deduct TDS. But where the payee itself is not known, I make a provision only for the purpose of, since I am following a mercantile system of accounting, and I have to make a provision in order to take care of all the expenses, which may, which may crystallize at a later stage. In that situation, one can possibly take a view that the TDS is not required to be deducted. Now, moving on to the next section, 194IB. I think this section, I'll not spend too much time. Basically, this is applicable to individuals and HUF. If they, make the payment of rent of 50,000 for a month or a part of the month, then in that situation, whether or not you are subjected to, even if you are not subjected to, tax audit provisions, you are required to deduct TDS under section 194IB. Now, the next important thing is 194IA, which is TDS on, transfer of immovable property. Now, this TDS provision basically says that, when I make the payment, as we all know, when I purchase the property, I have to deduct TDS at the rate of 1%. Now, 2-3 important things which I just wanted to highlight, though we all may be dealing with this provision in, day out, is that 194 applied to, amount paid by way of consideration for immovable property to a resident transferor. So if it is a case of a non-resident transferor, then probably 195 would apply, not 194IA. Then the tax is required to be deducted at 1% of the consideration. Now, earlier there was no provision of taking into consideration the stamp duty value. Now the law has been amended to say that you have to deduct TDS on the consideration or stamp duty value, whichever is higher. So therefore, if supposedly the consideration of property is say 100 crores and the stamp duty value is 125 CR, now you will have to deduct TDS at 1% of 125 CR, not the actual consideration which you may be paying to the transferor. Immovable property is defined to include land, building, and so and so. And consideration is defined to include all charges. So it includes, maintenance fee, car parking, membership fee, etc., etc. Now, what is important, one issue which I just wanted to highlight in this context is this, if you see section 50C, etc., it gives you an option to challenge the stamp duty value in the hand. So the transferor can say that the stamp duty value is not representative of the true fair market value of the property. Now, the issue which may arise is, for the purpose of tax withholding, how do I take care of it? So, for example, sorry?
No, Rohit, I'll just request you slightly.
Sir, I'll just very quickly just finish it in 2-3 minutes, sir.
Take your time. Take 5. Just.
Yeah, I'll just finish it in 5 minutes.
Thank you. Thank you. Yeah.
So, the important issue which I wanted to highlight is, so for example, in 50C, you have an option to, request the assessing officer to, refer it to the valuation officer. But there is no such, leeway or the provision in 194C. There is no corresponding provision. So therefore, in my example, if I make 100 crores as consideration, 125 as stamp value, whether or not I contest that stamp duty value as not representative of the fair market value, for the purpose of TDS, I still will have to deduct TDS at 125 CR. So that's the issue which I wanted to highlight, that the option of going to the DVO for the purpose of valuation is available to the transferor, not to the transferee who is supposed to deduct TDS. Now, these are some of the questions which I have just highlighted. Considering the time constraint, I'll just take one or two rather than taking all. So in case of transfer of share in a society, as we know, sometimes what happens is, when I, for example, in cooperative societies, when I purchase the share of a cooperative society, by virtue of that, I become, the owner of the property or an immovable property. Now, the issue may arise whether when I purchase a share of a society, whether I will be required to deduct TDS under 194I. Possibly the view would be 194I would apply. The reason is, if you see the definition of section 247, it specifically covers these kind of transactions, and it takes you to 269 UD, etc., etc. So better view would be that TDS would apply. Then whether, payment which is when you purchase the property from a, the family member, whether TDS provision would apply. There is no specific exclusion or an exception, so it would apply. But the larger issue would be in case of family settlement, whether the TDS provision would apply. So since in family settlement, there is no transfer per se, or in case of gift, there is no transfer per se, 194 IA according to us may not apply, but otherwise it would apply. In case of multiple, transferors, of course, we will have to, for the purpose of threshold, you will have to see the share of each of the, the transferors. In case of exchange, since exchange is also a way of transfer, so therefore 194I would apply, IA would apply. Again, the controversy would be whether, in the absence of any actual consideration, 194IA would apply or not. If we go by the strict language of the section, it may not apply, because it says amount paid or stamp value, whichever is higher. Now, there is no payment as such in a case of exchange. So one can possibly take a view that, TDS provisions would not apply, but the conservative and the better view would be, it's better to, since this stamp value is available, better to deduct TDS under 194IA. GST, no, there is no clarification on GST whether 194IA would apply or not, but probably one can rely upon the circulars issued in the context of 194IA, etc., which says that GST component is to be specifically excluded for the purpose of tax withholding. Again, capital contribution under section 45(3) or contribution, the distribution of property by partnership firm 45(4), whether 194IA would apply. According to one can possibly say it cannot apply because there is no actual consideration. It is only a distribution which is happening. But then probably a conservative view would be better to deduct TDS based on at least the fair market value or the consideration as reported for the purpose of 45(3) and 45(4). There is no provision for going for 197 in case of 194IA. Now, 194IC is basically a TDS on the joint development agreements. One or two things which I just wanted to highlight was, it is applicable only if the payments are made in terms of a specified contract. Now, the specified agreement is specifically defined to mean a registered agreement for, joint development of the property. A larger issue which may arise is whether if it is not a registered agreement, or if the joint development is with a person other than individual and HUF, whether this provisions would apply or not. Again, one can possibly take a view, technically that is not applicable, and therefore this tax withholding may not be required in terms of 194IC. I think I'll hand over here. Thank you so much. Over to you, Anil sir. Thank you so much.
Thank you, Rohitji. Thank you very much. As always, extremely well done and very informative and very interesting. Thank you. My next speaker is Ajay Wadhwa, advocate come CA. I can see him now smiling as always, and I'm sure he's more than well prepared with a lot of interesting points to discuss. Ajay ji, as we are way beyond our time, which is no fault of any of you, try and compress it a little. And I still have 250 people wanting to listen to you. So they are still logged in, which is a reflection on you, on Rohit, on other speakers. Thank you very much. Mr. Wadhwa is a CA lawyer. He has done across the board. He has a diverse experience in tax matters, litigation, advisory, appellate, search, surveys, transfer pricing, international tax, FEMA. So he's done it all and continues to do, and I'm sure he'll be doing it for a long time with increasing skill and expertise, which he very readily shares with everyone. And I think he enjoys it, his work, which leads to the interest and to excellence. Ladies and gentlemen, Mr. Ajay Wadhwa, and he will be talking on consequences of an assessee in default in context of interest penalty prosecution. And a little briefly, because we are way past time. Yeah. Thank you.
Thank you, Chopra Saab. Thank you so much. You know, Mr. Chopra is ever so kind with his words. And thank you. And apologies, of course, that this had to come to such a state that we are well past 6:30. But Mr. Chopra just told me that I have now the audience till late in the evening, till dinner. And dinner is going to be served by PhD Chamber of Commerce. So don't worry, we can go on till I sound absolutely boring and you want to just shut your... Another feather up Mr. Chopra's cap is 460 odd participants when it started. So Mr. Chopra, kudos to you for having such a wide audience, and it is only because of your charisma, your knowledge, your ability to carry, your ability to structure such programs, summarize, and ability to get the very best, minus me. So now I start.
Thank you.
And
inclusive of you, it's not me, it's you and all my friends here.
Thank you so much. So in deference to the directions of Mr. Chopra, I am not going to go into the longest sort of lecture that I have thought of. I'll go into situations, but before that, I'd like to just run through the section. And if Ayushi, you can help me with the screen, please. So just give me a minute, and we just have the section on the screen, and let's read the section quickly together. And then things will come up and will become very much clear. So I have highlighted in yellow the portions which I want to stress upon, and on which there is litigation, there is some understanding to be had, and there are some case laws. So, assessee in default. Now, you want to catch an assessee who's a deductor. You first have to make sure that he is an assessee in default, and assessee in default is by virtue of an order under section 201 clause 1, which the assessing officer is supposed to pass. Once he passes an order specifying the defaults, the assessee is in default, and then all consequences of interest, penalty, and prosecution follow. Now let's read section 201. 201(1) says where any person, including the principal officer of a company. Now they have included the principal officer of a company. I've highlighted because earlier they merely said any person, and any person includes a company. So a dispute arose whether a company can be prosecuted. It's a juridical person, and there is no individual. So whether it can be prosecuted or not. So they have now introduced the word principal officer of a company, which means that a company and the principal officer will be prosecuted for an offense. Then A, who is required to deduct any sum in accordance with the provisions of the Act. So this means in accordance with Chapter 17 of the Income Tax Act, a person who is required to deduct tax at source. Then, of course, they have covered in B, the salary also. Now it's important. I want your focus for a moment. So a person who does not deduct or does not pay, or after so deducting fails to pay. So they have taken three situations. I think they have covered all the situations. So let's see the first situation. Here, there is a person to whom you raise an invoice, who is a deductor, he does not deduct. Now, he does not deduct. He makes no deduction in the books of account. He simply credits you. And or he does not pay. What happened? No? Yeah. Again. Are we there? Okay. Am I there, sir? Hello?
Very much,
Hello,
very
hello?
much, Ajay. Very much.
Yeah.
Yes, sir, we can.
Okay, fine. So I can't see myself. That was, and I love to see myself. Anyway, I think, okay. So let's come on to expenditure. So a does not deduct, does not pay, or after so deducting, fails to pay. So 3 situations. He does not deduct at all. He does not pay at all. Does not pay means he has paid the entire money to the person. He may have paid the entire money, but he does not pay to the tax department. Or after so deducting, he makes a deduction and he doesn't pay. So in all the 3 situations, he becomes an assessee in default. And in default in respect of such tax which does not pay. Now let's come on to the next situation, where if you see, just point the arrow here, not assessee in default is supplied by us in the capital. That's not the section. So now there's an exception to a person who doesn't become an assessee in default, which says, provided that any person, including the principal officer of a company, who fails to deduct the whole or any part of the tax in accordance with the provision of this chapter. Now, let's pause here. So, you're talking of a person who will not be held to be an assessee in default, who fails to deduct the whole or any part of a tax, which means a person who has deducted, but he doesn't pay, will not be covered by this. So, a person who doesn't deduct, let us say he receives a bill, he simply credits the bill, he doesn't deduct the whole or part. He makes a part deduction, he doesn't deduct the other part. Then he can be held to be an assessee not in default. He shall not be deemed to be an assessee in default if such payee. Now let's understand, friends. What does the tax department look at? A deductor deducts tax and pays on behalf of the payee. Payee is the recipient. Payee is the person who's supposed to show the receipt as his income. So I am holding, if I'm a deductor, on behalf of the government of India, tax on their behalf in a fiduciary capacity. So the government of India, or the income tax department, takes a very serious view where you deduct the tax, but you don't pay. Now, if you deduct the tax, you don't pay, you will see in the subsequent section, you are liable for interest, you are liable for penalty, and you are liable for prosecution also. But if you don't deduct at all, then what is the liability? And if you don't deduct at all, or you deduct only a part, then you are not an assessee in default if the payee, that is the recipient, has furnished his return of income. So he must have furnished his return of income, has taken into account such sum for computing income in such return of income, and has paid the tax due on the income declared by him in such return of income. Now, let's quickly go through the 3 provisions. So the condition where the deductor will not be held to be an assessee in default is when he fails to deduct the whole or any part of the tax. And he is able to establish before the department. Now the burden is on the deductor to establish that the payee has furnished his return of income. And then he has taken into account such sum for computing his income and has paid tax on the income. Now the question will arise that how do you judge whether the payee has shown the amount as his income? After all, income ordinarily means income as per the statement of tax that you file along with the return of income. Here, income means that, let us say, if somebody has raised, he's a commission agent and he has raised an invoice of commission on me. His commission income is 1,000 rupees. He has raised an invoice of rupees 10 on me. Obviously, the 10 will not be reflected independently in the return of income. that 10 will form a part of his total commission. So if it forms a part of his total commission, then clause 2 is satisfied. Then clause 3 is that he has taken this amount as a part of his income, total income, or his receipt, and he has paid tax on the income declared. Now, the next question will be, what if there's a loss? There's an overall loss in the return of income, even after you considering the amount that he has billed me, that is rupees 10, even then there's a loss. So here also, it means that even if it's a loss, as long as the return of income is filed, the amount is taken for computing the income. If there is a tax due should be paid. It has been paid. If there's no tax due, it doesn't have to be paid. So you will qualify within the situation. I have, there need not be any case laws, but I have still furnished case laws in my subsequent presentation. If you get to it, I'll show you. But you can have the presentation. I'm sure it's going to be circulated and you will get to see them all. Now, the important thing is the person furnishes a certificate to this effect from an accountant in such form as may be prescribed. Now, for all the three, if I engage an independent chartered accountant who fills up form 26A, in 26A, if we see some columns, they say whether the amount which has been billed or which has been credited by me as a deductor, if that amount forms a part of his gross sales or gross receipts. So if you look at the certificate also, it comes out that the income means inclusion of the amount in his receipts or in his books of account or in his profit loss account in any manner. As long as it is finds place in his profit or loss account on the credit side, it is accounted for. So that's the other one, friends. Then I'll move on to the next quickly. Penalty. Now, if oh, Monica, it's okay. Now, penalty. Now, it says no penalty. In such cases, if you are an assessee in default, penalty will be levied. And penalty will be levied to the extent of tax in arrears, unless there are good and sufficient reasons. Now, good and sufficient reason can be what? Good and sufficient reason can be misinterpretation of a section. Let us say there is a receipt which ought to be under 194H, but the confusion is that you account for it under 194C, treat it as a contract, show to the assessing officer that, look, I didn't have the necessary wherewithal, I didn't have a chartered accountant to assist me, I'm not that big enough, and therefore was not able to distinguish between 194C and 194H, has still made a deduction under 194C, although it ought to have been under 194H. This is a good and sufficient reason. However, the next question would be, what about financial stringency? What about financial problems? Is that a good and sufficient reason? Can I argue before the assessing officer that, listen, I didn't have the money to pay TDS? Now here, there'll be a distinction. Now, if you credit a person, you pay the amount to him, but you do not pay the TDS, this cannot be a good and sufficient reason. You had the money to pay him, but you didn't have the money to pay tax, cannot be a sufficient reason. But well, you credit him, you don't pay him at all. His bill is not discharged. That probably can be a good and sufficient reason. So it depends on the circumstances, the provision. Now let's come on to the interest. So penalty I've shown, friends. Interest. Now interest is levied in two stages. If I don't deduct tax at source, then the interest will move. The interest meter will start from the date when the tax was deductible to the date when the tax is deducted. That will be 1% per month. So 1% per month till I deduct it from the due date when it was deductible. And then if you move on to the next, 1.5% for every month or part of a month, which is that if I deduct and then till the date I actually pay, it shall be 1.5%. So a greater evil is that you deduct and you don't pay. That's the time when you are visited with a higher rate of interest, and a lesser rate of interest where you don't deduct, but till the date you deduct. Now, let's come on to the next. The next heading is, even if person is saved by first proviso, interest has to be paid. Now, this is again very important. Now, if you saw the first proviso, which said that you have failed to deduct tax at source, but you are able to show that the payee has furnished his return of income, has taken that income into account for computing the income in such return of income, what happens? So here the section says, you may not be held to be an assessee in default. You may not be visited with penalty. You may not be visited with prosecution because the deductee has already paid, but you will still have to pay interest. And the interest will be from the due date till the return of income is filed at the 139(1) by the deductee. So there will still be interest even if you are held to be not an assessee in default. Let's move on to the next piece. Charge on asset if TDS is deducted but not paid. Now here again, if you deduct tax, again, a serious consequence, because you have deducted tax and you don't pay, then the tax which you have deducted, not paid, along with interest thereon, under 1A, which has been computed above, shall be a charge on the assets of a person. So, but if you don't deduct, obviously you don't pay, it's not a charge. Then we come on to the time limit for passing an order. Now, time limit for passing an order is whenever, earlier what used to happen is that the assessing officer will wake up one fine day, 10 years from the date when the default has occurred, and hold you as an assessee in default. So they put a cap now which says expiry of 7 years from the end of the financial year. Now, this also is harsh in my view. It shouldn't be more than 4 years or maximum 6 years. So they say whenever the default takes place, within the expiry of 6 years from the end of the financial year in which the payment is made. So that's when the assessee, the assessing officer can hold you to be an assessee in default. I will pause here now for a moment. I want to take up a situation which has come before us. And friends, please engage with me on this. Now, we got an assessee who is a broker. He's a very huge, big broker in the sense, in terms of the revenues that he generates. And he had, as the developer, a very big company. And then the broker had sub-brokers underneath him. So the sub-brokers would bring business to the broker, raise a bill on the broker, and the broker in turn would raise a bill on the developer. The developer would pay to the broker, and the broker will distribute the money to the sub-brokers. Now, there was an agreement between the broker and the sub-brokers that, listen, I'm an intermediary, I'm keeping some percentage myself, but unless the developer gives me money for the invoice that I've raised, I will not be able to pay you. I will pay you only when the developer pays me in respect of the invoice that I raised. And the payment scheme was that if the customer pays 30%, X percentage will become due. If he pays 40%, X plus will become due. So that's the way it used to be. So the sub-brokers would keep a track of their customers, keep raising invoices on the broker, saying that now the customer has paid 30%, ours so much is due. Now he's paid 40%, so much more is due. And the broker would record the invoice in his books of account, but not deduct tax at source. Now, he would acknowledge the invoice by saying, I have acknowledged your invoice, but I will not pay, I will not accept the liability till the developer pays me. Because if the developer doesn't pay me, the man who is supposed to get the benefit, who's supposed to get all these persons, the customers, then I am not liable to pay you. This was the situation. So what did the broker do in his books of account? The case with me is of the broker. So he made a provision based on the invoices raised by the sub-brokers. And the provision was also exact. Provision was also in the name of the brokers. But provision, of course, had that caveat that unless I receive the money. And this provision was made at the end of the year. The broker did not deduct tax at source. He did not. He simply credited them because he was unsure whether he will get the money from the developer. Now, to the developer also, he raised invoices. Developer did not pay. So in that year, he did not pay. In the next year also, he did not pay. So in the next year, what he does is he reverses the receipt income from the broker, receivable from the broker, receivable from the developer, and he reverses also the invoices with the sub-broker that raised on him, saying that I am no longer liable to pay to you. So the result is, in that year, he creates a provision, shows his liability to pay to the sub-broker, but in the next year, because he doesn't get the money from the developer, he reverses those. Not in the same year, in the subsequent year. Now, there's a judgment somewhere in the note that is here, where it says that if in the same year you reverse, there's no problem. But here is the case where the reversal has happened in the subsequent year. What happens now? The assessing officer says, you have not deducted tax at source. Had to deduct tax at source. Show me whether the payee has shown this as income. Obviously, the payee wouldn't have shown this as income because he hasn't acknowledged their debt. Now, what is the recourse available? Can the assessee be held to be an assessee in default? That's the question. Now, friends, for this, I will read section 194H. 194H for a second. And because that's where the tax deduction to a broker is dealt with, and in respect of commission. Now, section 194H says, any person not being an individual or HUF who is responsible for paying on or after such and such to a resident any income by way of commission shall at the time of credit of such income, I will stop here, which means that whenever I am responsible to pay any income to a deductee, then whenever I make a credit of that income, I am liable to deduct tax at source. But the word is income. Now here, what we are testing is whether I am an assessee in default. I say I'm not an assessee in default at all, and TDS, the provision should not apply to me at all because I have reversed the provision. I have also stated when I receive the invoices from the sub-broker that I will pay you, I will acknowledge this liability to pay only when I get the money from the developer. Now here, what is the concept? So here, section also says, when you recognize this as an income of the payee, that means I recognize the obligation to pay. Now, here comes the judgment of the Honorable Supreme Court in the case of A.D. Sassoon and the latest judgment in the case of PGW South Private Limited. Quickly, I'll tell you. When is the right to receive? What is the interplay of what is income? When does income arise? When does income accrue? Income accrues when the right to receive the amount is vested in the taxpayer. So, if the sub-brokers have raised an invoice, unless the broker says I have received the money, the invoice is not payable because that's the agreement. So, the vested right to receive this arises when the money is received and the broker says I have received it and I'm going to pay it. Here, vis-a-vis the broker and the sub-broker, the broker has to have an obligation to pay. He should say, I'm going to pay. I'll just give you an example. In the case of PG South Private Limited, what happened? There was a rental agreement. In 1994, a fresh agreement was drawn, supplementary agreement was drawn, wherein the tenant agreed to enhance the rent with retrospective effect. Retrospective effect means 1988 for 6 years. Assessing officer reopened 1988 to say that it is retrospective, the income accrued in 1988. Supreme Court said no. The right vests to receive this money, the arrears, is in 1994 when you have entered into this agreement. So unless the tenant acknowledges to pay the money, though with retrospective effect, the enhanced amount, it is not an amount which can be treated as income. So friends, the case that I'm talking about is that with a broker of a sub-broker, it does not become an income at all. So a word of caution. The word of caution is that whenever you are in doubt as to whether the amount has to be paid or not paid, add these caveats, have a memorandum of understanding that I'm going to pay you subject to this. Whenever this happens, have that acknowledged so that the income to the payee doesn't accrue. Then make a provision, don't deduct tax at source. Because the moment you deduct tax at source, it's an acknowledgement of a debt. That yes, I have deducted tax at source, I acknowledge that this is your income. That's the way it can be construed. And better still, that you make an ad hoc provision without even giving the name. Now, these are all mitigating circumstances. I'm not saying you get away, but these are all mitigating circumstances. One gets wiser when one reads the case law or one deals with these cases. Now we can quickly run through I will not take more than 10 minutes now. We'll run through 5 minutes rather. Let's run through the slides. If you can just put it up. Now, this first one is, this is actually a judgment by the Honorable Supreme Court, after which that provision came, which I've just read. In Hindustan Coca-Cola beverage, it says that where the payee has already paid tax, you cannot hold the defaulter, the deductor, to be an assessee in default. And he cannot be visited with penalty. That is what is the judgment. Based on this, the provision was altered. Let's move on to the next. No, sorry, just go up a little more. Just go up a little more. A little more. Yeah, the para 2. To declare a deductor who has failed to deduct tax at source as an assessee in default, condition precedent is that assessee has also failed to pay directly. So that's this. Now I would, friends, request you to read Jagaran Prakashan Limited 345 ITR 288 Allahabad High Court thoroughly. It's a great decision which shows the interplay of section 190, 191, 195, all these sections. It's a very good judgment. You will get the entire flow of how income accrues, how the liability shifts from the deductor to the deductee and vis-a-vis the government. Let's move on. Let's move on, please. This is into a few pages. We can move on further. Please move on. Yep, please move on till you have the next para, which is 3. Move on, please. Yes, please move on. Yeah, okay, 3. Now, duty is cast on the assessee. Now, stop here, please. On the assessee to show that payee has paid taxes, and this responsibility cannot be transferred to revenue. Now, what happens is, let's say the payee has paid tax, and the director says, listen, I know the payee has paid tax. Now, I request the assessing officer to evoke section 131 of the Act, summon him, or under 133(6) inquire whether he has paid tax or not. Now, this is the Ahmedabad High Court judgment decision, which says the responsibilities of the assessee to show that the payee has paid tax. So you cannot shift the burden to the assessing officer, because the moment you shift the burden to the assessing officer, then everybody will not deduct tax at source and say, assessing officer, sir, please call the deductee and see whether he has paid the tax or not. But I would, as general law, there are decisions which say that there are certain situations. Let's say with the deductee, I've had terrible relations. We have fought. I'm not in terms with him. He's become my enemy. Now, can I use the assessing officer? I know that he has paid the tax, but I'm not able to talk to him. I'm not able to speak to him. Now, there's an impossibility of performance. I'm not able to get through. Can I then request the assessing officer to invoke his inherent powers, call the deductee, or help me get open the PAN? I mean, because I can't get an access to his portal also. Can I do that? My answer is yes. If I'm able to show to the assessing officer the mitigating circumstances, the situation vis-a-vis the deductee, request him to look into whether he has filed his return of income for that year, has paid his taxes or not, I certainly can. But not if I'm unable to show such circumstances. Let's move up, please. No, this is, yeah, please, at 4. Move further, please. Let's forget about the yellow. Yeah, 4. Here, this is what I had discussed in my case. In the absence of accrual of income, there is no obligation on the part of the assessee to deduct tax at source. So, friends, these are all judgments which you must read, which show that if there is no acknowledgement of a liability to the deductee by me, if no income arises to the deductee, mainly because I made a provision does not mean that I become a liable to tax, I'm liable to direct tax at source. It does not mean so. I have to go into the general law. I have to look into the judgment of the Supreme Court, which says an income accrues when I am obliged to pay him. I agree to pay him. And he gets a vested right to get the money. So in such a situation, you may be compelled to pass an entry, but don't make a provision for don't deduct tax at source, and at the same time communicate to the assessee that you will not be able to honor his invoice because of such and such reasons, and therefore the income doesn't arise to it. Let's move on, please. There are 4 or 5 case laws. We can move on. The yellow part can be read by my friends themselves. 7, move on, please. Yes, stop here for a second. No, just go back, please. Just go back, please. Yeah. Now, if you see clause 5, procedure for refund of excess TDS paid by the deductor. Now, there may be situations where TDS has been paid by the deductor. One finds that payee has also paid tax on it, and the deductor also paid later on. Now, so there is a CBDT circular. I won't go into it. I'll send it across. You can all see it. There are subject to certain conditions. The deductor can also seek a refund, or the deductee can seek a refund if the deductor has not sought so. Then there are case laws. Sorry, please move back. Please move back a little bit. Yeah, Apollo tires. Yeah, clause 6, where I do not know, I do not have the identity of the payees to whom I have to pay. I'm making an ad hoc provision. I have a feeling that there's going to be a huge liability on me from 10, 15, 20, 30, 50, 100 people. So I make a provision. I had employees who have left me. They are liable to make, they are likely, or agents who have left you are likely to raise a bill. So I make a provision. That doesn't mean that I'm required to deduct tax at source on such ad hoc provision, because the income doesn't arise. I have not acknowledged the liability. It's only as an abundant caution that I've accounted for the same in my books of account. Move on, please. Yes. Amount of expenditure. Okay, please move on. So this is the same. It's a continuation of the same. Continuation of the same. We can, no, please go back a little. Please go back a little now. Go back, please. Yeah. Now this is important. What I said. Proviso to section 201 makes no distinction whether the deductee files a return with positive income, nil income, or even losses, as long as the payee has taken into account the sum for computing income. That's it. There is this Bangalore judgment decision where you say all that you have to show is that the deductee has filed as a return. If the income is nil, so be it, as long as the amount has been accounted for in his profit loss account, in his gross receipts, or in his income. As long as that happens, even if there's a loss, no problem. Move on, please. Again, same thing. Okay. Now stop at 10. Contradictory pronouncement. Now, what's a reasonable cause for non-deduction of source tax at source? There could be pronouncements by high courts where they say this is not income, no tax has to be deducted. And then there may be other decisions which say otherwise. Now, is that a good, reasonable cause for not deducting tax at source? The answer is yes. The judgments again. Let's move on, please. These are all judgments which can be gone into, including Hindustan Coca-Cola. Let's move on. Delhi High Court. Is extreme financial position sufficient good? You can go through this judgment, but as I explained to you, if you have paid the deductee and not paid the tax which you have deducted, I'm sorry, this is not going to hold good. But if you have not paid the entire amount, including the amount payable to the payee, you can argue you don't have the money, therefore you haven't paid the entire sum, and probably get away. Move on, please. Sorry, just go back a little. Yeah. So again, bona fide reasons where no penalty can be visited with. Another example that I have just given in the case of the Delhi High Court. Belief, bona fide belief always is a cogent reason for not being visited with penalty, because penalty is a pecuniary liability. It's a penal action. It's a quasi-criminal action, and therefore, if I am able to show my bona fides, no penalty will be levied. Please move on. Now this is now I'll tell you, this is not the correct decision, but I've still put it here, which says that if you've already suffered a disallowance under 40A-IA, 40A-IA is that you are liable to deduct tax at source on an expenditure. You have not done so, so the whole expenditure is disallowed. Now, this is a decision which says that if you have already been, the expenditure has been disallowed, there is no liability to deduct tax at source. You will not be held to be an assessee in default. This is not so. This is completely contrary to what the provision is. Provision says, without prejudice to the other provisions, the other consequences that may follow, you will be held to be an assessee in default. Let's move on next. You can still read it, but I think this is per incuriam the provision of the act. Let's move on to the next. So prosecution. Yeah, many people say prosecution has been launched even though no 201 order has been passed. We have not been held to be assessee in default. The answer is yes, it can be. Prosecution doesn't have to wait for an order to be held under section 2011, although normally they do so. But if there's a default which exists, which is manifest, prosecution can be levied because they both operate on two different platforms. Prosecution is not dependent upon the quantification of the amount. 2011 is quantification of the amount once you are held to be an assessee in default, which is the tax in arrears. Criminal proceedings are not dependent on that. As long as the moment there's an offense, you have not deducted tax at source within the limited period, certain amounts have been mentioned by the CBDT, you cross those amounts, prosecution is levied, it can be launched. Let's move on next, please. Sorry, can you go back a little, please? Just go back a little. Yeah. Prosecution only in case where assessee after deduction fails to pay. So only when you deduct and you don't pay, that's the only time when you are visited. But if you don't deduct at all, obviously there's no question of payment. So you can only be penalized. There can be penalty, there can be interest, but no prosecution. Well, friends, that's it. Thank you so much for a very patient hearing. We are at 7 o'clock. Chopra Saab, I have tried to stick to your diktat and we have exceeded by a few minutes. And thank you very much.
Brilliant and interesting and animated. And you've got everybody awake as if it's 10 in the morning. I don't think anybody's concerned. It's late evening. Most of the participants who were there at the beginning of your talk are still here. And if people had heard, many would have come back. So thank you very much. As I said at the beginning, it's your interest in the matter which makes it interesting. And certainly I have heard every word and appreciate it. We now have the vote of thanks from Mr. Sanjeev Chaudhary. Sanjeev is a very senior member and old member of the Direct Tax Committee of our chamber. He's known to all of you. He's been a past member of the Central Council. He is one of the few Indians, or maybe only, I don't know, who has been a member of the International Ethics Standards Board for Accountants, New York. Ethics is a word which is very dear to all of us. He's a CPA Australia, a Bachelor of Law, apart from being a CA, a member in Solvency and Bankruptcy Board of India, and was a partner with the BSR & Co., advisor to ASA, BDO, others. A long and distinguished career, which is still to see its best. Many good years to go. And again, a dear friend. A vote of thanks from Sanjeev Chaudhary on behalf of the chamber and all of us, please. Yeah.
Thank you very much, Anilji. I think a very extensive introduction for a person who has to give a vote of thanks. I think, first of all, I think the TDS provisions are TDS actually. And they actually, put a lot of obligation on the deductor. Deductor actually basically is working for the government of India at times. So instead of being appreciated, one is liable to the interest, penalties, prosecution, as a lot of speakers explained. I think thanks to, first of all, Anilji for getting such a good galaxy of speakers, each one of them, starting with Gaurav, Harpreet, Mr. Patnaik, Sarilji, Rohit, and to top it all, in the end, but outshining many others, Ajay in his true typical style, I think brought so many things. I've been listening to all of you for the last more than 3.5 hours. So though actually Anilji said, you can join around 6 o'clock, I said, look, might as well get the benefit of listening to the stalwarts sitting at home, and not even go out of the house. So fantastic seminar. We started with about 500 people actually. We're still close to more than 200 plus people on YouTube.
Yes.
So I think that speaks volumes for the speakers who we had today. Thank you very much, everyone, for your time, for your contribution, for sharing your knowledge. And thanks to Anilji and PhD for putting this together. I think we can get back to whether the PhD or respective homes. I can go to Ajay's house for actually a drink. He lives close by. I'll just have to walk across. So,
Yeah. You'll have dinner, courtesy PhD. They just come in. The food is just coming.
Thank you very much. Thank you very much, sir. And all the very best to everyone. I look forward to more such deliberations from PhD, which can benefit all of us. The professionals, the SSCs, and the thrust of it can go back to the department with certain suggestions as well. Thank you, everyone. Thank you, Anilji.
Thank you, everybody. Deeply appreciate your participation and being here. Thank you.
Thank you. Thank you, everyone. Thank you, sir.
Thank you, Monica.
Thanks, sir.